Nobody cares. Hi, Michael. The treasurer didn't care. Happy Thanksgiving, Mr. Treasurer. It's lovely to see you today.
At my age, it's nice to be sitting there.
Oh, good one. Why don't we get started? Thanks everyone for being on
Good
time.
afternoon, Governor.
What, good afternoon, but it's only morning, Tim, at least where we are. Okay? Certainly, before we open the meeting, Mr. Treasurer.
Clarification, because of the executive order of 2 hours to let the Santa Fe Public Schools. Are we going to violate the Open Meetings Act by starting this meeting in the state of Florida?
I don't believe so, as long as we provided notice, and it's not impossible to be here, even if others make a decision for a 2-hour delay. But duly noted that the treasurer is appropriately, and I mean that seriously, concerned about both the Open Meetings Act requirements and about folks getting access to us in this meeting. Thank you. Anybody else before we start? Good question. All right. Seeing none, why don't we do the roll call?
Okay, Governor Michelle Lujan Grisham,
Present?
Treasurer Tim Eichenberg,
Present.
Commissioner Stephanie Garcia Richard, Peter Frank,
I'm here.
Linda Eidson,
Present.
Tim Jennings,
Here. Present on the phone.
Harold Lavender,
I'm here on the phone, President.
Lee Rawson,
Present.
Michael Messina,
Present.
and Tracy Hartzler.
Present.
You got a quorum.
We have a quorum.
Quorum?
Yeah. So thank you for roll call. And do we need to do introductions? We can. I haven't done that in a while, actually. So why don't we, for folks who are viewing and listening, let's go around the table. I'm going to start with member Michael Messina, although I sort of introduced you.
Michael Messina, glad to be here.
Nice to see you. Tracy Hartzler.
Tim Eichenberg.
Linda Eidson.
Lee Rawson.
Olivia Padilla Jackson, DFA Cabinet Secretary.
Governor Lujan Grisham.
Steve Moise. Ed Smith.
Good morning, Everland.
Richard.
Charles Baldwin.
Marcia Beaver, Dr. King.
Good morning, Ken Stower, Harvey Day.
Gordon Sellers, SIC.
Oh, Bruce Brown, SIC. Griffin. Jack Oak, the Townsend Group.
Clay Camper, SIC staff.
Brian Burke, Sun Mountain Capital. Lee Rand, Sun Mountain Capital.
Dan Pritchard, Renewable House.
Dan Schlegel, Governor Staff. Mikhail Kuznetsov, SIC.
Carol Bennett, SIC staff.
Nino Carpenita, SIC.
Clayton Cleek, SIC.
Chris Cassidy, SIC staff.
Richard Pugmire, Commercial.
David Selden, Angie Partners.
David Lee, SIC.
Bart Stuckey, SIC staff.
Controller Ryan, SIC staff.
Welcome, everyone, and thank you for making introductions. Next, we have approval of the agenda. Do we have any changes or additions to the agenda? Yes, Secretary?
Governor, I move that we approve items 3B and 3C up the agenda after 2B, the CIO report. I know that some of the members on the phone would be interested in these key items and voting, and I know they have limited time, so. I move
Okay. Do we have a second for that motion? Just to move items 3B and 3C, votes or actions on private equity issues and recommendations by working groups to immediately after the CIO report, which is 2B. Are there any, yes, Senator Wilson?
Well, I was just gonna recommend we move item D and E before B and C, but what my concern is that we have people that come in from elsewhere, and particularly today when we have weather issues, is we get our visitors in and out quicker. I'd like to see visitors, the things that we're voting on, or folks have come a long way, I'd like to see those things earlier in the agenda so they can get in, get out, and on the track. It's just an observation that it may not make a difference today, but in general, I think it works smoother. And then things like the internal stuff, like the private equity, that's just us anyway. But if we've got members, that's another issue. So I just voice concern.
Duly noted, Senator, so we'll ask the staff to make sure that when we are putting the agendas together, that we consider changing the action items and presentation items in favor of considering who's coming to these meetings, who has to present, and their travel back. Do I have that right? Thank you for that, we appreciate that. Do we have a second for Olivia?
I'll second.
Senator Dawson seconds. Any questions, comments, or further discussion about that? Seeing none, although Harold, were you trying to say something to me?
No, Governor, I was trying to second it again.
All right, it's hard for me to hear, I'm sorry about that. All right. Seeing nothing further on Secretary Padilla Jackson's motion, all those in favor say aye. Aye. Any opposed? Any abstain? Motion carries. All right. So I think I need now a motion to approve the agenda as amended. Senator Rawson so moved, so I have a second. I have a second by Michael Messina. Member Messina, thank you both. Thank you, Linda. Any discussion? Hearing none. All those in favor say aye. Aye. Any opposed? Any abstain? Am I going too fast for the phone callers? Apparently not. Okay. Next on the agenda is item 1C. It's approval of the minutes for the October 22nd, 2019 meeting. Do I have a motion? Thank you, Member Eitzen. We have a motion to approve. Do I have a second? I have a second by Secretary Padilla Jackson. Any discussion, changes, concerns, amendments? Hearing none. All those in favor, say aye. Aye.
Aye.
Aye. Any opposed? Any abstain? Seeing none, the motion carries. The minutes are approved as presented. So now we're going to go to item number 2. It's the State Investment Officer and Chief Investment Officer reports. Remember, we're going to do the first 2. So, Mr. Moise, you are up.
Thank you, Governor. I will be very brief because I know we need to move along for those on the phone who have other things and for those that are here. Current net asset value as of this morning has been reported at $26.86 billion. The price of West Texas Intermediate oil as of yesterday showed a closing of $57.94, and total distributions from the permanent funds to the state over the past 12 months have totaled $985 million. The second item on my report refers to New Mexico-centric investing. We will have discussion today on 2 separate voting items that I know each of us will find interesting and encouraging. Under item C, I'd like to just recognize Tracy and say how thrilled many of us, I know of no one who isn't thrilled that you are now going to be the president of CNM. I think that speaks very well for the search committee and the board of CNM, and we're very fortunate to have you, but sorry that you will be leaving us at some point. Congratulations, Tracy.
Yes, congratulations.
2 of our committee members are retiring as of the end of the year. Both of them have served several years and they've done excellent work for us. Gene Sanger will be leaving the investment committee and Jim Goodwin will be leaving the audit committee. Gene, after 7 years of service, and Jim after 8 years of service. And both of them have been just superb, substantive, thoughtful, committed committee members, and we thank them. So we will need at least one more CIC member, and one more investment committee member, and one more audit committee member. And in December, the governance committee will begin to consider suggestions for those positions, and we'll have something for the council in January. We consider to continue to source a couple of analysts. One is our financial analyst that will be supporting Brent's group. We're awaiting state personnel office approval of a person who we believe will be highly qualified for that role. Under a legislative agenda topic, the three things that, as of right now, we think we will be involved with are these New Mexico private equity matters that you'll be considering today. Trying to find a better way to make the Water Trust Fund sustainable, and an early childhood education permanent fund proposal. There will be action, I think, coming from the New Mexico Finance Authority Oversight Committee and the Water Trust Board to make the Water Trust Fund more sustainable. And that legislation hopefully will be drafted and available soon. And finally, we have an Investments and Pensions Oversight Committee meeting scheduled for December 4th. We are not high on that agenda, but we will be present to respond if needed. Thank you, Governor.
Thank you. Are there any questions or comments for Director Moise by any of the members? Anyone on the phone? All right, thank you very much for your presentation and your recognition of staff and changes in membership. We appreciate that. Next on the agenda, we have item 2B. We'll have the CIO report. Mr. Smith.
Thank you, Governor. I'll also try to be brief here, and about half of my presentation is investment performance, so we'll skip to that section, or do that when we get to that section. Typically, we start the process of writing the annual investment plan in October when the IMF puts out its semi-annual report. We discussed that report just briefly last time, but just in review, the IMF sees slowing growth globally. They have some fiscal issues that have popped up, mainly debt levels and deficit levels in major economies. And they remarked quite voluminously on monetary policy and how that seems to be mostly spent. That the ability for governments to cut interest rates is very limited. Quantitative easing was used extensively to get us out of 2008, 2009. We have not pulled that back to get those assets back off of balance sheets of central banks. So monetary policy is in a tough spot. So we're seeing a combination of slowing growth. We've been talking about that with a lower ability for central banks and governments to deal with it if it really falls off and gets into negative territory. So we're monitoring that very closely. Current status, though, we've talked a little bit about how manufacturing globally has been in a recession, including here in the U.S. It's been less noticeable here in the U.S. Manufacturing is only about 15% of our economy. The consumer obviously is the biggest, more than 2/3 of GDP. But in some other economies, Germany in particular, Korea, a few other heavy manufacturing economies, it goes in recession or close to recession. That seems to be bottoming. We're starting to get some indications that manufacturing sector is at least hitting brakes in terms of downward slide of seniors. So that's a good positive sign. Many economists are seeing the low point in the economy coming just about where we thought it would be, second quarter of 2020. But most think we'll avoid a recession. Most of the recession models I see run anywhere from 25 to 40% chance of a recession in 2020, or at least over the next 12 months. So that's good if we can avoid slipping into recession there. We will be very weak. We'll see, at least here in the United States, we'll see certainly no more than 1.5% GDP growth, right closer to 1% real. And a number of other economies, particularly Europe, probably slipping into a recession in 2020. But I think here in the United States, we may avoid it, at least the models are indicating we might. Returns are slowing, and you'll see that when we give our presentation on performance after the New Mexico items, New Mexico investment items. We've been tracking a number for you because I think it's indicative of the environment, and that's the annualized rate of return on the S&P 500 from the last sort of high water mark, which was January 26, 2018, so almost 2 years ago. We had our sort of our last high water mark. We were compounding about 4% from that rate. That's increased to a little over 6% now. So if you look at the annualized rate of return from that January 26, 18 to yesterday, it's a little over 6%. So that's improving. That's a good sign. Now, you need to think about that in context. Stocks normally return 9 to 10%, so we're about 2/3 of our normal rate of return from the stock market. 2% of that 6%, 2 percentage points of that 6 percentage points is dividend yield. Another 2% is inflation. So we really only have about 2% real growth in stocks since that last high water mark. And much of that, and that's on a per share basis, much of that has been share buybacks by corporations over that period. So there's not a lot of real growth still in the S&P, but it is positive. If you look at those same numbers on a global scale, which the United States is around 45% of the global equity markets, that's between 0 and 3%, but it's up from negatives for just a couple of years ago, from just a couple of quarters ago. So some improvement there in the stock market, a lot though due to factors that, in the long run aren't contributory on a net basis. That's the share buybacks. Although inflation's been reasonably low. We'll talk about how we fared in that environment, I think you'll be pleased, when we get to the performance section. Just some trends that are going on, I wanted to just highlight for you to kind of keep in the back of your mind. About half a dozen or so state level public plans have done asset allocation studies in the last year or so. Every single one that I've seen have had that exact same trend we've been talking about, and actually we've been involved with since about 2014, and that's moving money out of publicly traded equities and putting it elsewhere. The most popular elsewheres are real estate, real return assets, and private equity. That's mostly where we shifted our publicly traded equity, and we really started taking off the table in about 2014. So that trend is very much still there. The old range for publicly traded equity and funds like ours was 55 to 65%, and spread that out to 50% to 70% to capture almost everybody. Today, it's about 35 to 45%, 20 points lower than it was just a few years ago in the old range. And if you spread it out to 30 to 55% to capture just about everybody. So big 20-point downshift. That's a pretty good sized move in a fairly short period of time for big funds like us. We tend to move our asset allocations very slowly. So a 20-point move is big. A lot of people have been on that move. I think that's part of the reason we've seen some good returns from our real estate, private equity investments in particular, and some of the real return investments. There's a whole wall of money coming behind us. We moved a lot of our assets in there in 14 and 15. There's been a big wall of money coming behind us. We think that's pushing prices and helping returns there a little bit. The second big trend that's out there, maybe to keep in the back of your mind, is turnover at the top level. At the top level in state level funds is starting to drop. That got pretty high, probably 6, 7, 8, 9 years ago. We saw some of the highest turnover among chief investment officers and executive directors in public state level public plans. That's really starting to drop. It's also changing in character. Back then, there was a lot of movement to the private side. Today, it's much more retirements. So funds have been successful at keeping CIOs, executive directors in their seats until they're ready to retire. That's a good thing. Just by observation, and I don't have any quantitative data on it, but just by observation, returns are improving. So you're getting folks in seats for longer, executing long-term strategies. That seems to be feeding into better returns system-wide in terms of relevant benchmarks and also in absolute returns. We'll talk about that a little bit more when we get to performance. Part of that slowing of turnover is another factor to maybe just keep in the back of your mind in terms of what's happening at other funds is when CIOs retire, funds replace them with a deputy. We've tracked this over the last 4 years now, coming up on 5 years. Of all the CIO turnovers at state level of funds, 80% have been replaced by their deputy. So funds are looking down into their staffs and finding qualified people there. I think one of the big reasons that has been causing some of this is a number of states becoming more competitive in the compensation area. So that's helping them keep senior folks in their seats until they're ready to retire. It's also providing a chance for deputies and things to get the experience and then move into those roles and being able to keep those folks. That's sort of the second wave we're trying to follow. Are they keeping those deputies in those seats? Or are they getting 3 years experience and moving on? So we're trying to track that. So just some of the trends that are going on out there. I think one of the funds that exemplify those is Washington. They just replaced their CIO last week with the deputy. They've been very competitive on the compensation side. The returns look a lot like ours, just the top half, not often the top quartile, but a lot at the top in that second quartile. And Matthias will show you a chart that shows that again, and you'll recognize it, you've seen it before. So just some of the trends that are going on out there, and that, Governor, that's my presentation.
Thank you very much. Do we have any questions or comments from members? Anybody on the phone? All right, seeing none, thank you very much for that overview. And we are now on to item 3B, and I noted that it looks like Gordon made sure to update who's president of the meeting to include the land commissioner. Okay, good morning. And we're moving up 3B and C based on a change to the agenda. All right, so we've got Linda Eichsen's going to give us the working group recommendations.
Our working group met several times and had some very fruitful discussions on the direction for New Mexico private equity. There was quite a bit of research that went into it, and we tossed around a number of ideas, and we did come to some conclusions on recommendations to the SIC for immediate action, and then other things that we might tuck away and consider in future meetings. The 2 things that we were seeking for approval and consideration from the SIC is one item, which is raising the cap on the amount that we can invest from the severance tax permanent fund in the New Mexico private equity program, raising it from 9% to 11%. The reason that we're doing that is in some prior years, when the stock market went down so much and the value of the fund went down, the amount that we had invested in the New Mexico program became a larger percentage. And that we hit the 9%. So we were unable to invest in New Mexico private equity for several years, and those ended up being some of the better vintage years. So to not hit that bump up there, we're just raising the amount to give us a bigger window in case there should be a market correction. This does not mean that we are directing the SIC to invest any specific amount. What we're saying is that we should, as the SIC, determine what is the appropriate amount to invest there, but it gives us some room that should there be a market correction, we can still continue to invest in those other vintage years. The other, which is a relatively small item, is there has been some uncertainty whether in that cap we are considering the SBIC money, which has been increased last year from 1% to 2%, and whether that amount should be included in the 9, now 11%. The belief is that it probably should not, but the statute was a little bit unclear that severance tax, that the SBIC was a totally separate program. And we just think we ought to clarify that language by statute, that it is a totally separate allocation from the now, what we're recommending, 11%. We said as items to consider, it would be nice if the SIC felt there was an opportunity for us within our prudent investor role to increase the New Mexico allocation. It would be nice if we should be able to do that. But we are, of course, as the SIC, looking at it as a prudent investor, and that's what the structure study showed us, is what is the prudent amount that we think we can invest on an annual basis. So those are kind of the conclusions that came from that. We also, very much like the Catalyst Fund, which is about 2 or 3 years old now, and that is focusing on the smallest of the venture capital. I mean, we're really talking about startups here. These are the real little babies of venture capital. And that provides us a real incubator for the companies that the funds might come in and invest in at a later date, because we need to start growing some of these ideas into real companies. And there were some things about that Catalyst Fund that we will not be able to replicate that made it especially attractive for us to invest. And we probably can't replicate that, but we said, is there a way that we can still come up with some type of a fund that encourages the growth of these new little companies, and can we look at that? So we also discussed that. That's kind of an overview, and here we have our consultants and our asset class directors to go through what the working group came up with and what their response has been on coming up with a structure study and recommendations.
Okay,
Oh, I think we need to approve that. I don't think
well,
so.
the structure, we've got 2 votes, one on the structure study, which is 3C, and then one on raising a cap. Do you want to separate those presentations so that we can do each of the votes?
Yeah,
Why
I
don't we
think
do that? Okay.
the 3B was just the working group
Right, we don't
recommendations.
need to vote on separate.
So we don't, okay, then I understand it. But we're done with the presentation on the working group, correct? You have nothing to add?
No, I think it's, member Eidson and the documents kind of summarized everything
Okay,
that the working group did.
all right. Go to questions. The first question is Senator Ross.
I'm just confused in terms of, I was thinking that the SIC was going to be making a recommendation to the legislature to make certain changes as a result of the working group. But if the working group is the subset of the SIC, so I'm just kind of confused as to how the pieces are fitting.
Linda, go ahead.
The working group is not a subset of the SIC, it's kind of its own little group. And so we are making recommendations to the SIC, and there are 2 statutory. One is to increase the cap from 9 to 11, and the other is language to clarify that the SBIC is a totally separate group of money. And those are the statutory changes that we are recommending the SIC to vote in favor of.
Okay, well, that's fine, but then that'll go into the structure study though.
Right, and the structure study, it came from our consultants and our asset class directors. And
That, those parts are integrated into the structure study, is what you're saying.
yeah, I mean, they were very
That's fine.
instrumental in the working group,
Yeah,
and they have addressed that, and they have done an amazingly
So we'll address,
wonderful job.
we'll address those 2 motions.
So just
Within the-
Correct.
Just to
That's fine, that's
clarify
fine.
that, the working group recommendations were recommendations to increase the statutory cap from 9 to 11, and then the structure study goes into the pacing, underlying pacing with the target of 9% that we're recommending.
So we are showing the approval of the working group as a separate voting item. So we should probably vote that first. And then the structure study comes up with
Correct.
how we're going to do that.
Correct, and agreed. Are there any other statements, comments related to the first vote, which is voting on the recommendations from the working group? Senator Ross.
Okay, that's what, I thought we were missing that part. Okay. I would like to divide the question
Okay,
in terms of 1 is changing the limit and 2 is clarification of the SBIC. So if we could divide that, but my questions, I have a few questions on raising the limit. So I don't know if I direct those to staff or to Linda, but it would now be appropriate to ask those.
why don't we do that? Let's get the questions about all the recommendations, and make sure that everyone's clear, and I appreciate that, so that when we take a vote, and that if you're at that point still wanting to make a motion to have two separate votes on the two main recommendations, then of course you are entitled to do that, sir. But let's get your questions answered first.
So what I'm trying to understand is, if we raise the limit, part of the concern was because of the recession, we then became over our limit. So that was the issue that was trying to be addressed, or I think was voiced as part of the main reason for trying to address it. Seems to me that we could easily solve that by simply saying that that percentage is based at the time of the commitments. So realizing that values are going to be going up and down, what was the value at the time of the commitment, and freeze it at that level is easier than trying to build in a slosh, just a slush of 2%. So did you guys talk about that type of approach?
Yes, we did talk about ways to value the New Mexico kind of equity portion in many different ways as to which value we would use for different purposes. And the market value is the value that we use for most assets, all of your assets when we're looking at asset allocation. And so that's going to be the one that we figured was going to be the standard one. So we preferred using the market value.
Okay, we're going to have the same problem though, are we not? If the market goes, okay, we invest in at 11%, and then the market drops, now we got the same problem.
Okay, that's why I said we are not saying that we shall invest 11%. We are, the SIC, not the working group, is the one that establishes how much we're going to invest. And we are the ones who have the prudent man rule. We also have a target return for that fund that we need to see if that allocation is going to assist us getting to our 6 3/4 long-term return. So the SIC is the one who says how much we're going to invest. So we're not saying that we're going to invest 11, 9, 3%. We're not saying anything. All we're saying is that if we don't want, and the language is mandatory, shall not exceed 9%. So we're just saying let's bump that up so that whatever the amount we determine is prudent, knowing that we've got that 11%, we've got more leeway.
As I understand it, it creates the flexibility at the time that you would need it when the SIC is recommending a particular market investment. Without that flexibility, you miss an opportunity.
Right.
And that's how I understand it as well. We aren't and shouldn't be mandating what exact target to reach and why, because that requires information back to us from the SIC and our consultants about what would be prudent and why. But this allows some flexibility, particularly given the changes in the market.
Was it my understanding? My understanding, the current target is 5, right? So we're not even anywhere near the 9, much less going to 11. But it just
Actually, I believe we've got 5, but if we're using market value, we're really close to 8. So
Correct.
we're really close to 8.
and of course that is, we're talking private equity, so that's kind of a guesstimate anyway. But
It is on all private assets.
well, no, I know. I mean, it's not like it's the public market, but I just think in my mind, I don't mind investing in New Mexico. That's not an issue. My issue is I don't think this is the right mechanism by moving that, because we're going to get to 11% and then we're going to have the same discussion because the denominator changes. It's kind of like we had this ranked voting in Las Cruces, and the denominator kept changing.
But it looked like it worked.
Huh? Well, no, because the cell.
Suppose, tomato. I think it worked really well.
The sell was that the winner would have 50% of the initial votes, and never got the 50% initial vote. But I'm just saying, that all we're doing is punting the issue down the road, because we will address it again if we get to invest in 11%. If we do find those opportunities, we invest to 11%, then the market goes down.
But without a statutory change, you limit your options during the year in which we would get recommendations from the SIC.
Okay, no,
So
I got
you would be
that.
locked in. Do you mind if David
Yeah,
responds,
so the
Senator?
working group recommendation is actually to cap.
Yeah.
Which is different than the target. And the target that we plan to implement, which is in the structure study, gives leeway each way for market movements, for denominator effects, so that, we recognize that there is a cap and we want to leave enough room so that we don't go there. So
And we're targeting a lower number than 11.
we're definitely targeting a lower number than 11. And with regards to suggestion that Member Rawson made, sometimes that gets a little bit tricky to just recognize the commitment at the time, because the problem is with the denominator. And the way that these private venture capital investments work, we stage these commitments in. So for instance, if we make commitments in January, we've got the denominator for the severance tax fund then. Then we make some in May, then we make some in November, then we make some in 2021. Which denominator do you use? I mean, I guess you could average them, but the point is that each of these commitments is going to be made at a certain time. That numerator, the top part, is locked in, but the denominator is not always changes. But I think if we could find a practical way of doing it.
Because I do know, Madam Chair, David, is that we are scoring on the reports we get. We know what our commitments are. We kind of freeze those numbers. So that's not like it's double bookkeeping or making it difficult versus the market value, because we're tracking market value, we're tracking what we committed values are. So it's not too difficult to do that. But that's, I got my answers.
Thank you, Senator. Member Edson?
Yeah, we actually originally thought that we would change the statute to be a rolling average. And then we decided, you know what, that's going to be harder to explain to legislators than just give it a number. So it was a compromise, and you're right, the valuations are such, they aren't market valuations, I mean, they're estimates. It's the best compromise we thought we could come up with for affirmative action on making this a statute that we'll be able to live with and to invest in New Mexico in down years.
Thank you. Any other questions or comments? All right, hearing none, I would entertain a motion to approve.
Just
Oh, yes, Mr.
divide it.
All right. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, and the working group memo provided to the Council today, I move that the State Investment Council direct staff to seek a change in statute to increase the legal cap on the New Mexico Private Equity Investment Program from the current 9% of the severance tax permanent fund to 11% of the severance tax permanent fund.
I'll second.
Second.
All right, we have two tied seconds almost. The Land Commissioner, I think that was Harold Lavender, Member Lavender.
Yes, ma'am.
All right, so we have a second. Any comments, discussion on the motion? All right, hearing none, all those in favor say aye.
Aye.
Aye. Any opposed?
Aye.
Okay, everyone's, we have no opposed, correct?
I'm opposed.
Okay,
Peter
let me do it again. So all, yeah, I think we just have one opposed, I'm just making sure. The phone folks, all three of you were an aye,
Yes. Peter Frank is an aye.
okay?
Harold Lavender is an aye. And who voted against, please?
Well, Senator Rawson, but Tim, did you, Senator Jennings, what was your vote?
Aye.
All right,
Aye.
okay,
hang on, Peter.
all right. Nobody abstained. So the motion carries, and we've got Senator Rawson appropriately identified as a no on the motion, correct? Okay, phone stuff is hard. Okay, we are now on item 3. Okay, I'm sorry. Okay. I'm sorry. I think we do this in such a bizarre fashion.
Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, and the working group memo provided to the Council today, I move that the State Investment Council direct staff to seek a change in statute to statutorily clarify that the cap does not include the current 2% statutory allocation to New Mexico Small Business Investment Corporation.
Do we have a second?
I'll second.
Senator Rawson seconds. Do we have any discussion on the second motion related to the first item? Hearing none. All those in favor say aye. Aye.
Aye. Aye. Aye.
Any opposed?
Aye.
Hearing none, the motion carries. All right. Now, I believe we're on item 3C, New Mexico Private Equity, the structure study.
Thank you. The structure study starts on page 146 on diligence. It goes into a fair amount of detail. It's 26 slides. So I just wanted to kind of give you the highlights that were in the executive summary.
Now, we want you to go through every single slide.
How much time do you have?
Duly noted. Thank you.
So the goals of the structure study, first, to increase the number of active companies in the portfolio, which we believe will impact the job growth figures. To also increase the number of managers in the program. So local companies will have multiple opportunities to raise capital. Foster a more robust local venture capital community, capable of leading funding rounds for companies. And finally, earn a positive return on an overall portfolio basis. We believe that the structure should include a dedicated allocation to seed and early stage investments, with also an emphasis on attracting regional and national venture firms with more extensive global investment experience and offering specific domain expertise in order to nurture New Mexico company investments that are able to reach a later stage of the venture capital life cycle. Excuse me. So thinking about it in terms of two parts, an emerging manager program that focuses on New Mexico-based general partners and would serve as a critical provider of capital for early stage investments. And then a fund commitment section dedicated to more regional national managers that address larger, later stage companies. The staff believes that the recommended portfolio construction in the structure study will result in increased exposure to early stage investments, which have not historically been an emphasis of the program. We believe there will be increased diversification from a financial return perspective. We think that there will also be more consistent investment pacing over time. And finally, local companies, as I mentioned before, having multiple opportunities to raise capital. As I said before, the slides go into detail, providing the statutory framework for the program. They show the type of investments in the program currently, give some background, recent performance, and outcome distributions for the venture capital asset class as a whole. They identify proposed goals and strategy for the program. They include policy recommendations. And finally, they include some benchmark recommendations. And those are my summary comments.
I apologize for interrupting. I can't hear David at all.
Okay, thank you, Harold. We maybe move, yeah, that's a good idea, Secretary. So it's right in front of David.
Is that better, Harold? Harold?
That's better.
Okay.
Thank you.
But I will have to say you are very soft-spoken.
Okay.
Okay.
I will try to be louder.
Well,
But we did summarize, Harold, we basically summarized what was in the executive summary at the beginning of the structure study, listing the goals, the structure, the advantages of the structure, and talking about the different sections. And what I was going to do was open it up to questions or comments. I have myself, Richard Pugmire from Mercer, and Chris Cassidy, who I work with, who do the vast majority of the work on this.
You're loud and clear, by the way. Thank you.
Thank you.
Okay,
I have a couple of, Governor, I have a couple of questions, please. One of the things that, in the course of the study, and if this is out in the wrong sequence, please accept the fact that I don't have a lot of time left on the phone. I had a new granddaughter, and we're on the way to California to see her.
congratulations.
So that's, one of the reasons I'm not there. The first question is the way the structure is set up, I just want to make sure that the regional managers that we're talking about, I know I'm guessing you're gonna get into that. I want to make sure that the regional managers when we call them regional managers, that doesn't preclude some New Mexico specific managers. So that we have the situation where, obviously, in my opinion, our goal should be to have as many investments made in New Mexico as possible, and as much of invested in New Mexico companies. And I think that I want to make sure that doesn't preclude the choosing a New Mexico manager to manage some or portion of the fund. And the second question I had, and it's not very clear, in the materials at all, what's the status of and what's going on with the co-investment fund? What's the future of that particular vehicle? If you can make sure you address those, I'd really appreciate it.
All right, go ahead, David. And then before, so to make sure, Member Eichson, did you have anything that would support the questions? I mean, is it related to that? Should you do your statement or question now too?
Not necessarily. I just wanted to say, I thought the structure study was an incredibly super job with great numbers, great research, great deal of thought, and taking us with a little bit different direction. But I was very, very pleased with the wonderful job. And I hope that engenders lots of discussion here, because this will be a new way for us to look at this program.
Thank you, and I appreciate the response to Member Lavender. I know that he's in a hurry, and who could blame him? But I'm interested in that answer too about the co-investors.
Okay.
Yeah.
So the first part of Member Lavender's question had to do with whether any New Mexico companies or New Mexico managers are excluded from the regional, and I would say no, they are not excluded. We simply we split the terms because we were trying to basically identify firms on one side that had more specific expertise, that had more of a regional focus, so that they weren't specifically just investing in New Mexico, so that we had a cause to invest in place. But it's a situation where we don't make up the majority of the fund. That's a long-winded way of saying that. With a lot of our managers, or with regards to our New Mexico managers, we may make up a majority or a vast majority of their capital. And what we are interested in also introducing to the program, which we have done actually in the past, is also get specific expertise from managers that are investing in other places, in other companies that are not in New Mexico, but that we feel fairly confident that they will invest their portion of the commitment into New Mexico. So the point of separating emerging manager and fund commitment was to sort of define them differently, to say with a fund commitment, we don't want to be more than a certain percentage of this fund that's investing in a lot of different places. We make different criteria for New Mexico-based investments or managers, given the fact that they are looking specifically in New Mexico. So it makes a little more sense that we're the majority of their capital. Now, we hope in the future that they eventually are able to attract other outside capital, because it is a best practice in this industry. But we feel like, we should have two different sets of criteria for this.
Now, remember, Lavender, we set up the emerging manager program to accommodate a number of managers which historically have not raised money directly from us, they've raised money via the Capitalist Fund. We do think it's an important part of the program to allow some of these firms the opportunity to raise capital directly from us. And it's an important part of any venture community to have local firms involved.
The way the council could think about it is you think of the ecosystem of the company from seed stage to early stage, later stage, growth, hopefully. We're looking at managers across that life cycle. We want, if a company may have been bootstrapped, has 5 million of revenue, we want to give them a chance to present with multiple managers and get growth capital from that. Likewise, we want local New Mexico funds to have capital to seed companies that give them a chance to grow and potentially become attracted to some of the early stage venture funds that are in the program. And so we're really looking across the ecosystem and trying to fund multiple managers to give companies a chance to get capital from multiple funds.
Right?
So, one thing, when you look at all this stuff, there needs to be something in here which talks about the orderly development of New Mexico or something. Everything's in something Albuquerque and Santa Fe anyway, and the rest of the state is way, there ought to be some preference about geographic distribution of some kind of things. Everybody comes and they want to take all the water from Pecos and send it up to Santa Fe so Santa Fe can grow it. And we need to have orderly development of the state. We've got, you look at every corner of the state with the exception of the southeast, but this state is really hurting. And Albuquerque comes in, they come in and put in a huge development in there for a plastic pipe plant. Well, we had one in Roswell. They damn near put it out of business because he gave them all the freebie. And our guy who was paying health insurance for every employee he had since 1970, whatever, 3. He almost put them out of business by, giving freebies in Albuquerque. And, so some of this stuff, the whole state, however we look, whatever directives we have, people need to look at the whole state as a whole and not just concentrate on Albuquerque and the Imperial City and Santa Fe. And, I don't know how you write it in there, but it needs to be in there.
Can we, this is the governor, Senator, do you mind if we leave out the Imperial City part?
No. I guess it could give some conflict between which one of them would want to be the Imperial City. I guess, all right. I don't want to create a fight with them. I mean, they get enough problems. But they kill each other up there. They use real bullets in Albuquerque.
Wow. Okay, moving right along. Did you get, so we've got 2 comments still about, I know to sort of round it up about maybe a little more flexibility in how we approach the structural study, including, for me, I'm also interested in the co-investment aspects, and we want to make sure that we, as we're looking at the categorization of managers, that we're clear that these opportunities to invest in New Mexico businesses and efforts need to be statewide, heard that loud and clear, and we want every opportunity to build capital and investments in an ecosystem that's productive for New Mexico businesses. That's certainly what I heard by both Harold, but more so by Senator Jennings. Sorry, Member Lavender, for using your first name.
So, the reason we set up the emerging manager program the way we did is it removes it will allow us to invest in a number of managers locally that historically haven't received capital, at least directly from us. And so a manager over 3 tranches can get the opportunity to raise up to $25 million from the council. And we would size those individual investments on the basis of the track record of the manager, what they intend to do with it, but it gives more flexibility. In the past, there was matching capital requirements that made it difficult for a number of local firms to raise capital from us, or we ended up getting a pretty small amount of money. So hopefully that increases the number of local firms that have to raise capital from us. And that's really the intention of the emerging manager commitments, is to allow that to occur.
We hope by setting up an emerging manager program with more managers looking in New Mexico, that they would be looking at opportunities besides Santa Fe.
That's the intent here.
That's the intent.
And historically, some of these managers have only had a chance to raise money through the Catalyst Fund, which had pretty rigorous matching capital requirements. And some of the feedback we heard from some of those managers is it was a little too harsh. They wanted some a little higher, so they wanted a little more capital, came up with $5 million for a first tranche and $10 million for the two other tranches. Is kind of a reasonable kind of middle ground in terms of giving capital to some of these people. Some of these managers have had as little as like $1 million from us indirectly, which isn't a lot of capital to have a real, kind of set up a real firm and set up a real strategy and be able to have it.
I ask a few questions?
All right, so is that Member Frank? All right, so, because it's hard to manage the phone. Member Frank, please ask your question, and then here's who I have in the queue. I've got the treasurer, and then I believe I've also got Member Messina. And, I'm sorry, and I missed the land commissioner. Everyone, and Senator Rawson. All right, so we're gonna go Mr. Treasurer, Mr. Messina, Land Commissioner, and Mr. Rawson after Peter Frank. All right, Mr. Frank.
Listen, thank you. These probably are not very well organized, and I am very much in favor of making changes to the program and improving its success. I object to some of the language in the report that infers failure by using adjectives that are probably inappropriate. I think our performance has not been nearly as bad, I think, historically, as some of the adjectives in the report suggest, so I object to that. Number one. Number two, I'm used to reports that approach that are written a little bit differently, that would say, we've done an assessment, and here are the issues and problems that we've seen with the current way that the program is being approached. I didn't really see it. I had to dig through to figure out what it is that you think has been wrong. I'd love to know what we're doing wrong and what changes we're making that will respond to what we've been doing wrong. As I said, I'm in favor of changing. I think it's great that we're doing an assessment. I just can't make heads or tails out of it in the report that you provided us. I'm not sure how we're going to find managers differently than we've done in the past. I'd like to see why. I have some explanation of what it is that we're going to be doing differently that will encourage managers and the country to respond differently than they have in the past. I understand, and I'm asking, is it correct that we still effectively have the technology to invest in the person we have in the past, which is that we have to invest, that any manager wants to invest the amount that we put into the program into the Mexico companies. That's still existing. And finally, I'm troubled by the suggestion that we should set a 5% target. I don't quite understand where that came from and how that differs from our current target and what the rationale is. So those are my questions. And I'll leave it to you, Paul, and others to respond.
Okay. I'll try to remember all the questions. In terms of the last thing, I think the target that we're shooting for is 9%. So that would be different.
No, I'm sorry. The benchmark return was identified as 5%. I thought it wasn't clear.
Okay.
And the other question, I mean, two more questions I have. I cannot understand the language in the report that says neither you nor our paid advisors will issue a recommendation. If you're not going to make a recommendation, and I understand that it's highly risky and nobody's making any guarantees. We're not expecting pavilions to guarantee results. But presumably, when you decide and put forward a recommendation to us, are you making a recommendation? Is that your recommendation? Or who's making the decision as to whether or not we should be following the course of action? And who's the advisor now to this program? I don't quite understand. Who will be the advisor to this program?
So Mercer's the advisor to the program. This stepping back a little bit to some of the original questions you raised, Frank. The feedback we heard kind of consistently across the board, particularly from the entrepreneur community, was there wasn't a lot of early stage capital available through this program, and a significant percentage of the program's capital went towards later stage follow-on investments. And given the size of the program and given its economic development goal of driving business formation, there was a sense of frustration, again, particularly in the entrepreneur community, that capital is not available in the early stage when a company is just developing an idea or trying to, that really early stage, which frankly is the most risky. And that's kind of generically kind of across all the different constituencies, the feedback we heard is that this program needs to have a little bit more capital available in that bucket so that when a local company wants to raise capital, particularly when it's the smaller check sizes in the seed stage, it's available and they have multiple chances for multiple managers to raise that capital. In terms of, the intention here wasn't to be negative about we wanted to give a reality check about the venture capital asset class as well as the program historically. We wanted it to be educational. The reality is that venture capital, particularly at the early stage, loss ratios are high. It's just a normal part of the asset class. You hope to minimize your losses, but at the end of the day, it is normal. We should expect there to be some losses in this program. It's not something to freak out about. It's just a normal part of venture capital. These are early, and oftentimes you're giving money to an entrepreneur at a very early stage. And so it wasn't intended to be negative. It was intended to be more realistic in terms of setting expectations about the underlying performance of individual investments in this program.
In terms of,
Can I stop you right there? Because I don't want to be so big today. And I agree with you entirely. I think that's the reality. I'd like you to go back and take a look at this presentation and look at some of the adjectives and comparisons that you made that would suggest to a maybe less informed reader that in fact our performance has been less than what we should have expected.
If anything, it was intended the other way.
Well, it doesn't read that way. I don't want to edit on the phone with you guys, but if you read some of the language where you say, you give some performance metrics and say, language is like only, or lower than, or we're only 3 companies that got more than 4x return, or something like that. I don't know about the language. All of that is not, in my view, not expected. My experience in private equity, our numbers are not that far out of line. If they are, we ought to put some metrics in to show that they are. But I think you kind of biased the language a bit. Maybe
it wasn't the intention. The intention was to set realistic expectations, and then going into the benchmark, we also wanted to be realistic. Managers that can look nationally, globally, regionally, that have a larger opportunity set where they can look at hundreds, if not thousands of companies and pick 5 to 10 years to make investments in. Those are going to have different risk profiles than the local guys that who have a more constrained opportunity set. And we set the benchmark. A good venture capital fund is frankly probably trying to at least triple its capital. A local firm here, if they earn a decent return and it's positive, I think, particularly given this program wants to take risks in early stage investments, I think that's okay. And we didn't want to be unfair and say that a local firm with a more constrained opportunity set needs to earn 30% IRRs, because we just don't think that's either realistic or fair. Now, to be clear, it doesn't mean if the New Mexico economy creates a number of highly successful companies over the next decade. It could go be the other way around. It could be, we could have some of the local guys producing outstanding returns, but, we wanted to recognize that it is a constrained opportunity set and want to be realistic when we're judging the efforts of those firms.
Member Frank, do you have any other questions?
Well, I have lots of questions, and I'm not sure I got full responses, but let's move on to other business questions at this point.
Okay, thank you. Member Messina, do you have a question?
Yes, thank you. First of all, I want to comment, I want to join Linda in commending you. I think for this
We
program.
cannot hear much.
I'm sorry about that. I wanted to compliment the work of this group. I think it's really important. I've been frustrated about this program, as some of you already know. And I think it's so positive to get aggressive about how we approach certain aspects of the program. I understand it doesn't come without issues and problems, but I really appreciate that. But I wanted to get back to Senator Jennings' comments, because being from a remote area, I share in some of these concerns. But I think what he was talking about was twofold. Number one, is there any way to consider geographical aspects within the state consistent with what you're trying to accomplish? And I'm not sure, I didn't hear a real response to that I understood. The second thing is, should we be also looking at the impact of potential investments on existing New Mexico companies that are employing numbers of New Mexicans? And so I would like just a little more clarification about those two issues, because for once, I agree with Senator Jennings.
I think the latter point you mentioned, something if I understand correctly, it's something we discussed in the working group, the way the statute's currently written. It's investing in companies headquartered in New Mexico versus what you're talking about, which is if a company may be based somewhere else, but is expanding a branch here, and can we give capital to that? I think the statute's more written for the headquartered businesses here, but
That's not exactly
there's validity.
when I'm talking about the geographical distribution, I'm talking about within New Mexico. And when I'm talking about the issue of existing businesses, I'm talking about the point that Senator Jennings made, that inadvertently we did something that in other respects is very positive, but it may have had a negative impact on another company, and overall it might not have accomplished the goals that we had. So it's slightly different, Chris, from what you're addressing.
I think in terms of the geographical distribution, I think the only thing I can say is it's fairly common in states to center more around population areas and where the workers are. That being said, that's not necessarily optimal. I'm not sure if within the confines of the structure study, we can necessarily do a lot more than to provide for a mechanism that has different managers looking presumably in different places, with everybody trying to do well, presumably. You would hope that some or most of these managers would look more off the beaten path or something that's attractive in one of the areas that's currently attracts most of the country.
It's not easy, I understand.
It is part of our sourcing and screening process, though, where we ask about past New Mexico investment. We just met with a fund a few weeks ago, had a successful investment in Hobbs, New Mexico. We actually got referred to a Southern New Mexico company that had done really well. We introduced them to a number of national and regional funds to see if they can get traction with some funding. So that's ways we're going to try to get more capital spread throughout the state. If there's a good investment, there's no problem getting funds to go for good investments. It's getting them aware that there's a good investment there, and that's what we're going to try to facilitate.
I just want you, it's good to know that you have a conscious awareness of this issue. Thank you.
Thank you, Member Messina. And I just wanted to check, who is still on the line? Senator Jennings, are you still there?
Yeah, I'm here. Yeah, I think it's Harold's phone that needs to be.
I'm here and I'll try to, I'm gonna try to, I'll mute again.
Okay, great. All right, Treasurer?
Thank you. I was gonna ask about, when you were talking about emerging markets, I wanted to talk about the 5% benchmark. You didn't answer the question the way I wanted to hear, which was, a definitive formula on how, but I think your guess is certainly better than mine, and so I'll allow you to whack that.
I think it was, honestly, I think it was an attempt to finesse the issue because some of the statute talks about generating income, so we're looking at something positive. But given the fact that it's, a constrained opportunity set, it's within the borders of one state. So we thought what wouldn't be reasonable, we thought what would be reasonable, and we kind of spoke.
Like I said, I like your guess better than mine, so thank you. And thank you for the work that you're doing. I think this is gonna be pretty exciting.
Thank you, Treasurer, Member Commissioner Garcia Richards.
Thank you, Madam Chair. So, my initial question actually was to Chris. You had made a statement about how a manager could have potentially access of up to 25 million over 3 tranches.
Yeah.
And I sort of kind of piggybacking on this idea of how do people in New Mexico access that? How do fund managers in New Mexico access that? What's the mechanism? How?
I think where we'll likely start is managers that have already been active in the community, and there's a number of managers in New Mexico that you may not be aware of that have actually been very active in New Mexico. That
So
historically we've co-invested
if
with.
we as members get questions about like, hey, you just
You
just had this structure study, you just talked about trying to funnel more money towards the early startup phase. Where do we direct them?
Directly to our staff, and we'll speak with them together.
But this is an attempt to try to find more managers in the community that have had experience dealing with institutional sizes of money, so that they can then turn around, if we can deploy that capital to them, so that they can start looking at earlier stage companies. So the companies themselves are going to be invested by the managers, and we hope to build a roster of, let's say, 25 to 30 managers that somebody with an idea or somebody with a company that needs funding can call. We can also talk to our advisor who has access and lots of relationships to even bigger firms in case an area that they're maybe an interesting technology that they have would apply to something that one of the larger managers would.
Okay,
Are you differentiating between the management? I think we can, just to be clear, we're talking about the managers that would invest in local companies. If you have local companies, you can also refer them to us, and Mercer has been introducing them to managers not only in our New Mexico program, but other managers that they know in the region or as part of our national program, or the managers that may not even fit either of those buckets. So glad to introduce those companies to different investors, whether here or nationally.
And so, Madam Chair, and I'm sitting here trying to think, I have interacted with VC folks in New Mexico before. I'm just, the names of the funds are escaping me at this moment, but, and while I still have the floor, I did want to address this issue about what we were doing previously was just fine, what's broken, why are we fixing it? And the comment was made that, the entrepreneurial committee, it's not just the entrepreneurial community. There is a reputation amongst New Mexico voters, amongst the general public, that this body does not do enough for investing in our own. That is, for good or ill, that's the reputation that this body has. And, as a new member, I'm a little bit reluctant to, I don't have really criticism that I want to share. I'm reluctant to kind of weigh in and talk about solutions, but I was one of the folks who wanted
to pursue this working group. My deputy attended the meetings and tried to sort of push us in a direction of, really looking at what other states are doing better than we are. I know that Mercer is involved in other state programs, and so trying to lean on their expertise to improve our investments in New Mexico. I used to represent Los Alamos, who experiences a number of tech transfer opportunities that sometimes have trouble getting capital. And so I think that we have, we have some potential here, and what can we do to sort of loosen up that capital for our own folks. So that was, I think, the impetus behind the work that the working group did. I have not read the report, but I'm very excited to do so, and I'm just real appreciative of all the work that we all went into. So
I think we tried to take feedback from a lot of different areas to put in here to try to come up with, what we thought was the most sensible structure. Chris and I and Richard, we've talked to local people, we've talked to people that dealt with Los Alamos and India. The reason why some of the comments were focused on entrepreneurs is because in the end, their point of view matters because they're the ones that have to invest in something, as opposed to sort of direct grants from the government or from this body. So, we want to know where the pain points are. We want to know what's good. We want to know what they're having problems with. And so we took a lot of meetings to try to gather a lot of that information, and we tried to incorporate that into a structure that makes sense.
Well, Madam Chair, I think I'm saying that I'm appreciative of that work. So thank you.
Yeah, thank you, Commissioner, for those comments. And Senator Lawson, you have?
Sure, I got lots of questions, but I'll try to focus. Yeah, I think the concern has been New Mexico businesses, regional or statewide, not just focused, but does the legislation, current statute, require a focus on high tech? And how does that impact? Or
Technically, no. There's a distinction between direct investments, where we decided the SIC invested in an individual company, and then the high-tech requirements are related to those direct investments. If we make investments via a fund, that is at least the way we read it, that requirement's not applicable. So if we invest in funds, the universe increases.
okay, so
But
that's,
again, given we don't make any direct investments in companies as part of our investment strategy, it's not applicable.
This body has.
okay, so the language on page 152 regarding the direct investments is, I was concerned that you would start recommending direct investments.
The last bullet is intended to, direct investments are not been a focus of the program historically, and we're not recommending that right now.
Because the intention was to move away from the Richardson era issues that happened with direct investments. Okay, so another question I'd have then is, particularly in the rural part of the states, people come to us as members and say, hey, how can we maybe be the recipient of some funds? And I have had a tendency just to refer those over to Sun Mountain, and then Sun Mountain follows up with them.
So
given this program, are you suggesting that we maybe take a different tack?
We want as many people as possible to get access to these local companies. So whether it's, for example, there was a recent company where you're from, which I believe you referred. Mercer introduced that to 5 managers. 1 or 2 of them are in our New Mexico program, 3 of them are in our national program, and I think they also introduced them to some other firms that were not investors in.
Okay, but I guess the question is we don't want to have a conflict of people coming to members. We want to help them if possible, but we don't want to, we need to keep arm's distance so there's no conflict. So who should we then have them contact, or how should that happen if it's not through Sun Mountain? Should we be contacting Steve, Should we be contacting David? Who should we be contacting?
You can contact us and then we'll refer it to Mercer, we'll refer it to.
No, I want a name, I don't want just us. So any referrals I'll have go to David then, right? That's great. So that I don't get.
We'll refer that to everybody we can, including other local firms, including Mercer, we'll give it to everybody.
Okay, now, another concern I have that we've had in the past, and you've addressed part of it with this structure study, is we have investments into New Mexico private equity from the SBIC, the SIC, the PERA, the ERA, and we've invested in some funds from a state corporate, level, well over 50%. And the structure study, the way I read it, said we're just going to limit out, hey, you can't be receiving funds from the SBIC. But so why haven't we reached out to say, hey, corporately, how much is New Mexico investing in this particular company?
That was an existing policy. That was in session,
Yeah.
okay. The SBIC no longer invests in equity investments in venture firms. They have existing positions from historical investments that haven't been fully realized, but our understanding is they don't intend to do those types of investments going forward. It's more debt, credit investments. So I don't think there'll be as much overlap as if that's what you're talking about in terms of conflict of interest. But that program is going to be more fixed income, and our program is going to be more equity based.
Right, with regard to the SBIC.
Yeah.
But we haven't addressed the potential overlap of the PERA or the ERA.
I'm not aware of a lot of duplicative investments.
I think we're the only one that has New Mexico program compared to ERB.
Well, they've invested in some of the same companies we've invested in the past. I'm just trying to make sure that the state doesn't have a dominant position. We're trying to say that we don't want the SIC to have a dominant position, but I think we need to look. So I would just encourage you maybe to encourage and have some wording that addresses that. So in regard to the target allocation, which we're raising to 9% from 5%, is that right? So we are basically doubling the target allocation, but then we're adding another 2% from the motion we just passed, right? And we're opting out, and I'm assuming the 5% target we currently have didn't include the SBIC anyway.
I think that was the historical understanding.
Right, so we're basically just we are increasing from 5 to 11% the potential of this one.
So 11% is a cap, the 9% is the target. So the cap is in statute, the statute's hard to change, the policy is gonna be a 9% target.
Yeah, but from the media's perspective, you want the media to know that we're doubling money, potentially doubling I'm just saying it's okay.
I
Benchmarks.
think what we want the media, and I didn't mean to interrupt you, to know is that we're making sure that we have the flexibility to make the smartest, most productive, prudent investments. And while I greatly appreciate your concern, we need it, and everyone's participation, I'm worried that should not be the press's perception about how we make investments. That's why we have professionals who make the investments based on a set of standard prudent rules. I just want to be careful that that's not the impression of the public by how this body works, because you all, prior to my incredible good fortune to be the chair and the governor, have done a really effective job about creating professional standards that have been met and adhered to, and you should be proud of that work. Okay.
The point I was trying to address is commissioners' comment about the perception that the SIC doesn't invest in New Mexico. And basically what we're doing with this is we're raising that potential even higher, almost double that, is the way I'm sensing. Whether or not we do it, because we want to have the prudent investment. Okay, just a couple comments. You talked about participation. And it's disappointing that the labor participation rate is still in the low 60s, that we can't get people out. Now in Las Cruces, we've got a pretty healthy minimum wage, which is 10.25. El Paso's minimum wage is 7.25. By the time you add benefits, we're $4 an hour higher in Las Cruces than El Paso. And so what we see is, of course, the deal is we're trying to help our people make more money and encourage it in the economy. Well, we become a service economy because you can't get the base jobs, the base manufacturing type of job when you're that much higher. It's now beginning to impact Santa Teresa. But we are getting more and more people coming up from El Paso to take the minimum wage jobs because they can make far more than they can make in El Paso. So to some extent, I would just kind of, just thinking back that you said where the jobs are. Companies want to come where the jobs are. And I would just remind everybody, because we kind of think, well, in Mexico, we got 82 million people. And, well, the jobs in Las Cruces, Doña Ana County, El Paso, and Juarez far exceed the population of the whole state. And now we got the whole thing going on in the southeast corner, which is booming right now. So the jobs and the investment need to be not just where the population is in New Mexico, if we're going to talk about where the jobs are, it needs to be the jobs are down there as well. So I just could, throw my 2 cents in. Thank you.
Thank you, Sandra.
I was already recognized, but I've got a couple other points. Of course, we want to, just as an aside, we want to get more than minimum wage jobs. But, and I hope we can support MPC too. I noticed, and I really appreciate that you have a provision for a full-time manager with at least 3 years of professional experience in assessing the growth prospects of businesses or evaluating business plans. But I have expressed to staff before the following concern. It's been my observation over the years, many times, this is especially true of technically based enterprises, that there is a big gap in folks that end up with the kind of technical properties that could be very, very successful businesses, often lack in business and financial experience, even to the extent of not even knowing how to put together a plan, what kind of capital needs they have. I don't think that this is the responsibility or role that the State Investment Council should undertake. But I do think in this state, we need an element of being able to provide that kind of expertise to potentially new companies, especially in the technological areas. And I don't think we have that, but we need some kind of technical advisory groups created somewhere that can help with this process. And that enables us to invest in entities that more likely can succeed. I don't know where we get that kind of expertise, but I know with one of the proposals today, one of the reasons we like them is they have that internally. But I really encourage thinking about how can we develop technical advisory groups or entities that can help with people that need that better understanding of how to succeed and have an ongoing relationship with these entities so that, with due respect, engineers and scientists think they know best about everything, but they don't necessarily know about management and organization and those kinds of things. So it's a very important point to me, and I wanted to just get it out there in this context.
Thank you. Anyone else? All right, are we ready to proceed with action on this particular item?
Governor Peter Frank, I don't know that I got an answer to my question, or I didn't get answered a lot of my questions, but I didn't get an answer to my question about why there will be no recommendation being made to the council with respect to new manager appointments.
I can take that. This is David Lee. I think there was a recognition from a practical perspective on the fact that we did want to include an emerging manager program that basically was dedicated towards more New Mexico-based investors, but with the realization that a lot of those firms or shops are smaller. They have little to no back office. They have certain risks, like key man risk. So I think it was just a recognition of reality that it probably wouldn't make that much sense to make a formal 40-page recommendation with, you know, 2 people in at a manager. At the same time, what we wanted to do was to see the managers that were available out there, and to kind of match them up with each other, to try to find, you know, people that we think will be successful investing in New Mexico. And then I think the theory was, instead of providing a formal recommendation like we do in the national program, instead we provide a summary sheet that shows, it talks about the manager, it talks about the risks, so that everybody is informed of what you're dealing with here, and you have enough information to make a decision without going to that last number.
And just to clarify, this is the emerging managers. This isn't other funds. Like Anzu today, you'll see a full recommendation. It got through our investment process. Our investment committee reviews it, and we came to a recommendation on Anzu.
But I think all you're saying, what you're really saying is, you don't want to run a 40-page report. I'm not suggesting that you run a 40-page report. I'm suggesting you come up with a different format. It could be 1 page, 1 paragraph, whatever.
Oh, no, there will still be a.
Somebody make a recommendation. And I think, given whatever standards you think are appropriate, however you want to put the context together, I think we need to have a recommendation from somebody that says, this is what we judge, in our opinion, is a good investment, given all the standards. Now, in addition, I think we're looking at my old concern, which is that we're going to be investing in taco stands here, which is the way we described it. I'm very troubled by it.
Mr. Frank, I object to what you just said, and I'd like you to rephrase about what you determine the risk to be to New Mexico businesses. I think that many of the members, including myself, found that offensive.
Okay, I'm not sure I heard all the words the governor, and I'm sure
The governor and at least one other member, may I, the commissioner, were offended that you said, I hope we're not going to be investing, and I quote, in taco stands. That was offensive.
by that,
Well, I don't know what you meant, but it was offensive. I want you to strike it and start again.
I didn't mean to offend. What I'm saying is, I think we want to be investing in decent businesses with good opportunities for growth, and we're not allowing ourselves to become a source of funding for every idea that people suggest might be a good opportunity for the state just to create jobs. That's my concern.
There's no intention of that, but we also realize that this program, the reason it was set up, it's a differential rate of return. It has an additional objective. We want it to take some additional risk. We want to be mindful of that, but it's an important part of this program that we take risk in companies in New Mexico and help business formation here, help job growth. And part of that is taking risk, and we're just being mindful of that.
Member Frank, did you get your questions answered?
Well, I heard the responses, Governor, and I certainly apologize for the inappropriate terminology that I used. But I think my concern still stands, and I still don't quite understand why we're not going to get a recommendation.
I think that what I heard, and again, I'm the new person in the room, is that while they didn't use the term recommendation, and probably Mr. Lee determining that one aspect of review would be a 40-page report and one wouldn't, which could lead someone to mistakenly assume that it's a matter of work related to this emerging managers group. that that's not what we mean. That given this particular strategy doesn't fit into the same review and recommendation process. And as a result, to call it such didn't make much sense. So instead, you're providing a summary sheet, and maybe we should refine that we're not just looking for the basic stats, but sufficient information that we can hold the team accountable for their recommendations to us. Is that correct? So perhaps that we've got, maybe we need a little language massaging in the report to adequately reflect that we're not minimizing our review and recommendation strategies, that we're using language that fits the appropriate context of the different groups and efforts, that we're not, we're looking at enough flexibility to not have to be so risk adverse that we miss. And here's maybe an example. New Mexico is one of the hottest, in fact, food places in the world, not just the United States. And in fact, there's incredible investment opportunities, I would imagine, in a number of emerging businesses as that happens. What they are and whether we should invest will depend upon what it is, who it is, what they're proposing, and what ultimately the experts decide. So I like having the opportunity, because I've been concerned that we don't give ourselves enough flexibility to invest in New Mexico, to support emerging businesses, to be clear that you need a number of diverse strategies to build the kinds of companies that when you look around the country, that those investment strategies have actually made a difference. I'm also clear that there is risk in everything we do. So as a result, we should be smart, we should be prudent, we should follow professional guidelines, and there should be sufficient information by all of the managers and consultants to give us what we need so that we can make those decisions. Do I have that right?
Yes. I think you do.
Okay.
You articulate it.
Thank you, Member Frank. Member Wright.
Okay, as chair of the investment committee, I can certainly suggest that the initial report that they come up with on these emerging managers will be something that is going to be a work in progress. But I mean, what we're going to start out and say, the goals of the emerging manager program are 1, 2, 3, 4, 5. Our experience with our managers are, we have the following managers, the following amounts, and these goals are or are not met as you go through them. We'll start with a report, something like that. And I mean, as we present it to the SIC, we'll come up with, when we put this in the report, let's take that out of the report. But that's what we're going to start with. So we shouldn't let the reporting be a problem here. And we on the investment committee will certainly have input as we see it before it comes before the SIC to say, hey, why don't we have this, why don't we have that? This has never been a problem. I'm coming up with suggestions back and forth. It works great.
Well, and
I was gonna just add, I mean, when we're at those meetings at the investment committee, I mean, we ask whatever we want to ask, and if we're not satisfied, these folks will come back with more information, more justification. It's not like they just come in and put something on the table. Obviously, they're not gonna put something on the table that they don't feel somewhat positive about. But the flow of information is really open, and the extent to which we get to ask whatever we want and get whatever information we want is wonderful. I mean, I really appreciate that.
And I also appreciate dialogue on complex issues, so I certainly hope I'm not overstating, and thank you for allowing me to make sure that I'm clear about what we're doing, particularly based on the number of questions and comments. I want to make sure that I'm still on track, and I appreciate that. Is there anybody else who's got questions, comments, or concerns? Okay. I believe that we are ready for a motion.
Madam Chair, if I could, I would like to add to Member Eisen's motion once she, for something to propose, so if you don't mind reading the main motion, if that's okay, I'd like that.
And I don't know if people can hear you, Secretary, so you might have the same problem that others have had. It's a hard room with not great acoustics, and we've got people on the phone. I unfortunately am a yeller. I have the opposite problem where people ask me to be less loud, not the reverse. And I think that what the Secretary is planning to do is to make sure that we continue to go down this line of flexibility. So if we might, let's have Member Eitzen make the motion. I think that the Secretary will offer a friendly amendment. And if that occurs, we should still be in a good position to have either a debate or not and a vote. Do I have that right? Okay. That'll teach me to leave the room. Look what you guys did.
Based on the recommendations of the Council Investment Committee and then Private Equity Advisor Mercer, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve the newly proposed goals, strategy, investment policy target, and benchmark for the New Mexico Private Equity Investment Program as discussed, reviewed, and memorialized by the Council today.
Thank you, Member Eitzen. And with respect to the approval of the strategy portion, I would recommend we approve this with the understanding that staff have flexibility to bring investments that may fall outside of these guidelines that are needed to achieve the policy target.
Second.
Did everybody hear that friendly amendment for the flexibility for Cohen?
So I'm just, as a point of order, is the motion amended to include that?
So this is what I'm hearing, good, and I'm not always perfect at Robert Rules of Order and the like, so if somebody wants to correct me, please, by all means, do so that we get it right. I take no offense to that. So if this is a friendly amendment, the person, so Member Eitzen would have to accept that amendment and change her motion to approve as such. Otherwise, we have to vote on that and then vote. So if you accept that friendly amendment to increase flexibility and that opportunity, still following the same structural standards, then your motion would be amended if you accept that.
Okay, let me take a stab at this language and see if that's going to be. I would add the following portion. With the flexibility of staff to recommend investments that may fall outside the strategy set out in the materials today.
In order to achieve the policy targets. Thank you, Member.
So I wonder if it's better, if we're better off rewriting the material and the amendments and then bringing it to the next meeting so you know exactly what we're saying and what we're doing. I think there were some suggestions made. I know I made some, and somebody else made other suggestions about some of the written material in the presentation as well that would be enacted. I'm happy to vote today if you all want to do that. I think there may be another process to get this fixed up as discussed and bring it back.
I agree with Peter.
All right, well, Member Lavender, Member Frank, make sure everybody heard that. They would prefer that we defer until the next meeting, and I appreciate that. There's been a lot of conversation about this particular recommendation. I just want to throw out that if we're trying to get ready for a legislative session, then that doesn't give us enough time to do that. I can tell you that as we're preparing for things at the governor's office, that all has to be done right now. Otherwise, we are not giving information and pre-filing and doing the things that this group would need to do in order to carry out the business that we want them to do. Is there a hybrid? And I don't know that this is possible, but here's the hybrid. It seems to me that there's general agreement about flexibility and targets. Where there seems to be some disagreement is how we have defined what we write as a recommendation or a summary sheet and some of the basic language that doesn't seem to be a policy shift per se, but more technical cleanup. If that's the case, I would recommend, or at least that we take a vote, assuming that the vote passes, ask the staff and the committee to provide some technical shifts and changes to the structural study report, and particularly to members Frank and Lavender and Rawson. Well, actually, you know, everybody here had a comment or concern of some type. Get that back to us as kind of a work in progress, as long as we don't change the overarching policy, that our recommendations about getting this report right would be taken into consideration and done. So you do both. We have a good report, it says what we want it to say, we don't shift the intent by virtue of the motion, but we continue to refine the issues. Senator Lawson.
Okay, I would rather approve it in concept and then approve a final document which we've all had an opportunity to review. Which I think is kind of what you're saying, but I don't want to approve this document in the current form. Now, from the legislative process, it seems to me that, you know, going from the 5% to 9%, we're not even at the 9% that's allowed now. So I don't see where it stifles any preparation by getting bill drafts and things like that, because we will have a meeting probably before any legislation is voted on. And as long as everybody understands the direction that the SIC is moving, I don't think it really hinders. I mean, I think that message can still be communicated. This is the direction the SIC is going. We're trying to provide the policy. So I would rather do it in concept. If you think you needed something prior to the session, it still gets you where you want to go, and then it lets others make sure they're satisfied with the wording.
I agree with Lee, and I think that we already approved those items that require legislative attention. This is really a structured study to guide how we operate going forward. So I think Lee has got exactly the right approach here.
Member Messina.
Well, I respectfully disagree. I think the sooner we get this thing in place, we don't have another meeting until when? January? I mean, there's a lot of work that can be done in the meantime. There's no reason why we can't tweak this and revise it over time. We're gonna have to work out practical ways of dealing with information and quote the recommendations that aren't quite in the same form as before. I think we need to move forward on this, and I think it's a terrific piece of work. With due respect, and if there's some language that is in here that can be interpreted negatively, I'm sorry about that, but I don't think it's material. I think we need to move forward.
Right, I was reminded that in the revised motion made by Member Eitzen, did we have a second?
Yes,
So we have an active motion on the table, and we're having discussion.
thank you,
Mr. Treasurer.
Thank you. I let Member Eitzen read from the script of what the motion was, because you had already stated that the member Lydia Jackson was going to have an addition. And so that's why I waited for the addition for the second. So I don't think it's a change of motion. Member Eitzen read the script. Lydia Jackson added to this, and that's what I seconded. So I think it's a good motion, and I like the work that they've done, and I like the way they're going. So thank you very much.
I apologize that I didn't hear your second. Thank you, and thanks for the clarification. That's exactly what I meant, so thank you. Keep me on track. Good luck. Good effort by all. All right, any further discussion?
Shall I reread it as with all the amendments in it?
So it's not amended. That's the clarification, and the treasurer's correct and I'm incorrect. So I compartmentalized it, because every time I didn't compartmentalize it, I was wrong today. And so when I finally get on track, now I'm wrong again. Good for you guys. That's sweet. So it's not an amended motion. Your motion includes a statement about flexibility. That has been seconded by the treasurer. We've had a robust discussion, and now the motion is ready for a vote. Senator Lawson.
So I have a question. Can staff give me an example of what would fall into the flexibility that the current proposal doesn't have? In other words, we have some guidelines in terms of what's an acceptable investment. And what I almost sense is I'm hearing a dumbing down of the qualifications, which we've already dumbed down the expected return. So I'm trying to process what's being requested. So if you can give me an example of where you might use that flexibility. that'd be great.
In terms of,
Go ahead. I just gotta make sure that I'm gonna call on,
Oh, Governor, I was wondering if the question should be directed at Mr. Lee or Mr. Cassidy or even Richard. Should it be directed more to our chief in this?
Well, that's fine too, but my
This
concern is.
is a policy that Vince is gonna have to follow.
Okay, that's fine, it's just, but in other words, if the focus more is on the target of getting 9 or 11%, or is the target, that's becoming more of a focus than trying to achieve a modest 5%. So,
Well, I think structurally, Member Rawson, it's just a change to a target rather than a cap. So that's what you're asking, to make sure that we don't, we talked about the denominator effect, make sure we don't run into that. In terms of a specific example of what might fall in that category, Dave's better to answer than I am.
keeping in mind the policy target, there are some things in this document that lay things out fairly specifically. I think the attempt to gain flexibility is merely a way to say maybe around the edges, if there's something that specifically doesn't hit all of the criteria, but would still achieve a policy target. I think you're looking for a specific example, but that's the best way I can kind of explain it.
well, I guess I've seen this in the policy you created. If we're gonna call it a policy, we should have a policy. If we wanna have a guideline and say, these are staff guidelines, that's a different deal. If we're gonna have a policy, now we're gonna run into, why should this policy be flexible and others not? I mean, to me, we got a policy and we got guidelines. So then I'd rather just say, well, this is the guidelines, go for it. But if what we're more focused on achieving, if the intent of the motion is to focus more on the target of 9% versus the benchmark of 5%, then I think we're headed in the wrong direction. So I'm just trying to understand the purpose.
memorize them. And then in the interest of time, I'm gonna cut off debate pretty quick, or discussion, not debate, discussion on the motion. Go ahead.
We have policy guidelines that we, that we, I guess I'll say the word violate, which is a little bit strong, from time to time. One is our allocation to managers not to exceed a certain amount. And we do have in our I believe it's, I can't remember, it's private equity or real estate, where we have a manager who has over 10%, and that violates it. But the reason that we do it is because they have unbelievable performance, consistent for years, decades. So we have said, we don't want them to exceed this as a policy, but it isn't a thou shalt not, it's a policy. And yes, we're violating it, but we think there's a really good reason. Okay, here, we might have the policy, they gotta have 3 years experience. So we find somebody who is an incredible entrepreneur and has founded 8 different companies, 2 of which went public and they're just great, but they've only been a fund manager for 2 years. And so we say, we'll violate that little policy.
I don't know that, I think there's a disagreement about whether there's any violation of any policy.
I don't think we're violating policy, but if you will, may I ask Vince to comment?
Yeah, it's that.
I think the policy's been, in the past, has been flexible enough to, that when we get to a guideline like that, we have the flexibility to move over into it. It's not, we don't see it at all as any kind of violation of the policy, it's just that we have the flexibility to do, to do something, and so we can set it in the guideline.
And we do this from time to time. It was pointed out, it's in our report. We talked about it. I mean, that's the flexibility we have right now. As long as we keep these communications open, these reports done, these are things that we talk about. So I absolutely agree with Member Messina. This is all we're talking about is the practicality of kind of getting this thing going. And this will be something that we kind of live with and get more comfortable with. But I think we've got something that we can vote on today. We're ready, we've got a manager right now, we're ready to move on. Fits right exactly within the structure study. Let's vote on it, move on, and we can work out the practicality of it as we look at this.
Mr. Lee?
Maybe as an example, if we had a concentration limit for a manager, or a concentration limit for the size of position, maybe as policy, we want to get to a certain point where we want to establish those maximums. But as an exception that would allow flexibility, what do you do about those positions that are currently in place? Now, there's suboptimal remedies to do stuff like that, but I don't think it's in the best interest of the state to do that. For instance, to sell an illiquid private position just to meet a maximum. So I did think of examples of perhaps situations that are currently in place, but we see where we want to go, so we establish those principles for the future in the policy, but at the same time, we don't arbitrarily rebalance that situation. Probably is not a good idea.
Or one of the other examples we've discussed is if a manager wants to invest in New Mexico and it's through a company that's not necessarily based here, but they're expanding here, how do you treat that? That would most likely be an exception. Is that something we should consider if it really creates jobs and have an economic impact, for example? But I don't have an example off the top of my head of that, but it's something we've discussed. So maybe we see down the line.
Some people may not, a company may not be willing to move their headquarters here. But if they're going to, establish a significant presence here, including Westford,
I thought we already opted out the requirement to have the home office here.
That's for the manager. The statute, the definition of the statute.
All right, I'm gonna call the question. We have a motion, we have a second to adopt the structural study and to continue the efforts of being flexible enough that we can review investment strategies and be ready for the session. All those in favor of the motion say aye. Aye. All those, okay, wait, who is the aye on the phone?
Well, I'm with me.
All right. Thank
I'm
you,
an aye.
Senator Jennings. Harold's an aye? Okay,
Yeah, I'm still waiting to see the revised report.
okay, all right, fair enough. We can always do better. So 3 ayes on the phone. Any opposed? One abstaining? All right, ayes have it, the motion carries. That was good debate, or discussion, I keep saying debate, I apologize. Yes.
Madam Governor, and members, just to respond to some of the concerns, I would like to ask SIC staff to come back with information about the co-investments and how those can be, viable part of this strategy. And so just an informational item, I would like to ask that to staff. Thank you.
All right, thanks everyone for your participation and your patience. We're back on the performance reports, and we are now back up on 2C. So you've got a performance report by Smith RBK, is that correct?
Yes, ma'am.
All right.
Okay, well, in front of you, you should see your October performance report. This is literally hot off the press as of yesterday morning. I'll just make one quick comment on it because what we need is the performance presentation today is the September, the detail around the September numbers. And we've only spent a good bit of time on the quarterly stuff. Yes, and Marcia had that in the past very quickly here. So turn to page 2 of your October report. We always start in that upper right-hand corner. That's your asset allocation. You can see you're very close to your interim targets. Around equities, you have about 500 basis points, 5 percentage points. The room, fixed income, we've got about 400, and the others is a mix 500 and 400 basis points of room there on either side. So you can see you're quite close to all of the allocation. The non-core fixed income allocation of minus 1.67%, we're slowly getting that close. We're getting cash withdrawals and some new investments that we made there. So you'll be seeing that number move below zero here in the short run. Same thing in real estate. We've got some new investments there that are drawing capital, and we'll see that move back to zero also here in the short run. So close to your targets where we want to be, particularly in a market like this. Down below is the absolute performance. Keep in mind when you run your finger across that total fund deposit or land grant line or severance tax line, that we're measuring this, particularly the longer run numbers, from the bottom of the last recession or near the bottom of the last recession. So we bottomed out in March of 2009. So we're only two quarters here, so past that. So you're measuring from a very low point higher. That's where you're coming in at 877 for the 10-year, even 840 for the 7-year. The 1-year number, remember, we're measuring that from very close to the bottom of the December quarter of 2018, where the market was down 20%. So really, it's the numbers look very good at the top line in terms of their absolute values, but keep in mind you're sort of measuring those from low points of those time frames. Alpha across the board, you can see there in land grant. You see a little bit of weakness in the near-term periods, month, quarter, fiscal year to date, calendar year to date. Some of that's coming from the fixed income markets. We've had interest rates drop. We have a little less duration in the bond portfolio. So as interest rates drop, bond prices go up. Duration is a measure of how much they go up. We have a little less duration than the market benchmarks have, and that's some of where that underperformance is coming from. Some of the rest of the underperformance is coming from the U.S. equity portfolio, although that's on improved. So if you look back 4 or 5, 6 months in your performance reports, you'll see significant improvement in the U.S. equity, and that's continuing as these markets start to change a little bit. So mainly the shorter term underperformance here is environment related. The portfolio, particularly the fixed income portfolio, has not changed very much at all from what it was a year ago. It's just a change in the environment, in particular, a drop in interest rates. So with that, I'll take any questions you might have on the October report. I know you haven't had a chance to review it. That's just a couple of comments, and after that, we can turn over to Marcia and Matthias for your September report.
Are there any questions about the October report? All right, you're off the hook.
Great. I will be happy to walk you through the September 30 executive summary that you should have. We'll just take a step back and give you some of the highlights for October. I'll try to provide a little bit more detail for that third quarter and calendar year to date period, along with some of the longer dated information. If I can turn your attention to page 18, just very briefly in the interest of time, look at the bottom left corner, that's market performance, putting really a lot of the portfolio performance into context. You can see that the S&P 500, so large cap U.S. equity, domestic equity, publicly traded equity, did reasonably well, up 1.7. Really all the other publicly traded assets, whether that's small cap within the U.S. or international equities, both developed and emerging, lagged their U.S. counterparts. There's a number of different reasons for that. Some of that is due to political tensions, trade wars that continue, some growth concerns going forward, as well as central bank policy. We also had the dollar move up, and one of the things that's always an impact is the dollar on foreign investments. And the dollar gets more expensive, those profits, by the time you convert them back into dollars, are a little bit less than they would have in their local currency. You can see the U.S. Ag, so that's the broad fixed income market, doing quite well. 227 for the quarter. But really, if you look out 1 year, over 10%. That's tremendous for fixed income. It's really a byproduct of what's been happening to interest rates. Interest rates have continued to come down. If you look at where we are at the end of the third quarter, 1.68% for the 10-year yield. That's almost a record low. Although compared to a lot of other developed nations, that's looking pretty attractive. Those countries that are fighting with negative interest rates. So we're seeing that over a third of all developed government bonds in the world are now trading at negative interest rates. So a third, that's over $16 trillion. It's pretty tremendous. And now there's some institutions in Europe, Denmark, and other places that are starting to offer mortgages at negative interest rates. So you actually pay back less than you take out. It's kind of a very interesting world. And what that's all done is meant that money continues to rush into U.S. Treasury as a result of that. Because even though 1.68 isn't terribly attractive, it's better than negative interest rates. If you slide further down, you can see real estate did quite well. The FTSE and the REIT, that's a REIT index. If you look at those numbers, those have been tremendous. There's a couple drivers for that. I think folks are by and large recognizing that this is going to be a low growth environment. REITs are fairly easy to access and pay a reasonable amount of income. So much like what we've been doing for a number of years, shifting away from focusing just on total return and appreciation and looking to finding sources that pay consistent yield is starting to be a concept that's embraced more broadly. Then you saw commodities by and large coming down a bit. A lot of that was related to crude oil and other minerals selling off, although a lot of that has corrected in the weeks after the quarter. So I just wanted to provide that overview as we look at some of the numbers. I might skip you ahead again, just in the interest of time, to page 24. This is a new page, and in response to a request that we had heard at a prior meeting to start providing the new funds that were incorporated and that are now the purview of the SIC to provide reporting on that. So you'll see the asset allocation, the mins and the maxes, and where those asset allocations are as part of their implementation process. And you all have been diligent in working through each of those funds and trying to determine what a prudent long-term strategic asset allocation would be. And you can see those reflected here in the target allocations, but granted, it's going to take a little bit of time to transition those portfolios from their current allocation to those approved targets. You can see that there are some that are still quite conservatively allocated. The Rural Library Fund, for example, when you look at their current allocation relative to the target, has some work, and the others as well, although the others are a bit closer. On page 26, this is the very high-level investment policy review to see how are the funds doing relative to the investment objectives that are set forth in the policy. You can see that both land grant and severance are meeting that return objective, both over 8% on that 3-year basis. But as we look forward, and Vince alluded to it, we are expecting lower returns going forward. I think we've all been very clear on that, and it's interesting when you look further down on the page just how strong the trailing periods have been, both on a gross and net of fees basis. You're quite effective at implementing a fairly diversified asset allocation. It does have a good deal in private assets, and despite that, the fee differential is quite attractive from that perspective. But as we move forward, we do anticipate returns being lower, and we'll continue to talk with you about that. Page 27. This is the attribution report. You can see how the returns were generated. Now, granted, this is just for a quarter. Really, by any measure, that's too short to draw any meaningful conclusions, but it's always insightful to see what was working, what was not working in a particular quarter. Some of those. Was there a question on the phone?
Maybe a cough.
Okay. Very good.
Guessing here, just guessing.
Right. I'll just briefly explain again this page, because I know you spent some time talking about it periodically. You can see the blue bar, that is your strategic asset allocation. So if you were to just passively implement the policy allocation, what you would have returned, in this case, 88 basis points. That compares to 98 basis points that you actually earned within the land grant permanent fund. And where did that 10 basis point difference come from? You can see that in the 3 remaining bars. Tactical asset allocation, which really is a bit of a misnomer. It's not tactical, it's just being different from your policy targets, and oftentimes just a byproduct of managing the portfolio. It's very difficult to be always right on. But you can see it's negligible. It's basically zero your style. So those are style differences from the broad market. For example, if you have various tilts, perhaps an overweight to emerging or a little bit more small cap that can either work for or against you. You can see there that that was a little bit of a detractor. Vince mentioned for fixed income having a little bit less interest rate risk or inflation risk was in this quarter as rates continue to come down even further. A little bit of a headwind, but generally that portfolio structure makes a lot of sense. And the same is true in non-core. That's one that's continuing to get built up, but has some shorter duration assets in there as well that held back overall returns relative to the broad market. On the manager scale, so the purple bars measure how well the managers do relative to their respective benchmarks, and you can see that you have managers that are doing quite well. They are outperforming, and adding alpha, particularly the publicly traded equity space. You're seeing outperformance both in U.S., non-U.S. equity. That's quite attractive. The subsequent asset classes there are more flat, I would say, more neutral. Then you see a little bit of underperformance in the real return. Some of that is MLP related, as you know. On page 28, I think the only comment there I'll make, and I think I try to highlight the differences because they have similar allocations. For the most part, you see the changes there being private equity and the ETI performance. We talked about the in-state private equity program trailing the national program. That's the case here as well. And so you can see on the purple bar, negative 30 basis points there, whereby on the line grant for the national program, it's actually additive. And ETI is a bit of a headwind there as well in the grand scheme of things. Again, those are the differences. Page 29 and 30. Page 30 we added, as I mentioned, page 29, you can see the returns there. A wide range of calendar year-to-date returns. Again, by and large, a byproduct of their allocations. When you look at the tax stabilization fund, had a return of 1.4. Again, that's because there's more than 60% in low duration assets that will return a lot. As those continue to be implemented and move towards their strategic targets, I think we'll see those returns normalize somewhat. Please let me know if I'm going too fast. I'm just trying to be mindful of time here. Next page is page 32. This is one that we always spend a good deal of time on. And as you'll recall, we've transitioned away from gross and towards net of fees, reporting this on a net of fees basis. Why is that important? It's important because you have a good deal of private market or alternative market assets that are really only reported on a net of fees basis. So when you compare yourself on a net of fees basis really to a peer group that's gross of fees, you have a bit of a handicap in terms of where your overall ranking is. So this is a much better comparison, and we'll see that in just a minute. The peer group that I think is most meaningful, particularly in terms of scale and the number of participants that are similar to your funds, is the bottom peer group. Perhaps we should move that up since it's the one that we tend to focus on, and that's the all public plans greater than $1 billion. The average plan in that peer group is about $15 billion, so it's right in line with the line grant as well. When you look at the various time periods at the top, I'll try to focus just on a few. You can see the rankings relative to the other plans. In this particular peer group, there's about 70 and change. So 70 other plans in this particular peer group, all on a net of fees basis. For the quarter to date, very good relative rankings, 25th, so that's in the top quartile for the land grant. And as you slide further out, you see the rankings for the calendar year to date. That's 76. But keep in mind what's happened really year to date. Numbers have been double digits in most asset classes. This is not a portfolio that's designed to be all the way out on the risk curve type of portfolio that would have done particularly well here. This is a much more balanced portfolio that would do well in a number of different environments. And so this calendar year-to-date period is particularly nuanced. When you look at the one-year time period that includes that last week of the fourth quarter, 2008, 18, where we had a tremendous sell-off, you can see there, you add a time period like that into the mix, and all of a sudden you're in the 44 level of median. So it goes to show that you have to be mindful that these shorter time periods don't always tell you the whole story. I think the great thing here, though, as you slide out 3 years, 5 years, 7 years, the consistency of the rankings that you have there, they all start with a 3 or a 4. So you're above median in many cases in the top thirds each time period. And the longer the time period, obviously, the more meaningful it is because it shows how consistent you are in your ability to generate these types of relative returns. We've always said that you don't need to be in the first percentile to get strong long-term returns, and I think this is sort of testament to that in terms of it's working. Page 33, I have to apologize. This says net, but it's gross, and that was our mistake. But we do have a handout that everyone should have that shows this information on a net of these basis. It's all the dots on there on the single one pager. But it's actually quite instructive to look at this relative to the page we have in the book as well, because it shows the differences between gross and net, and really the type of penalty that a plan like yours takes with substantial, as I mentioned, substantial assets and alternatives and private market assets that report only on a net of fees basis. And so the handout that you have is a much truer comparison. It goes to show just what you've been able to accomplish. You can see the concentration of those dots on the right-hand side of the chart. What that is, I counted them, 26 quarters in that basically above median, second quartile type of a place where it's really where we want you to be. So that's over 6 years, tremendous stability over a number of different environments, although they've been mostly on the up over that time period. And we expect that if you have any kind of drawdown and correction, that those numbers will perhaps even look better. So we're quite pleased with this outcome, and I certainly hope that you are as well. Lots of good decisions made along the way. I'll just pause briefly for comments and questions.
Thank you for doing that, member Bassini.
On page 32,
Yes.
under calendar year, and I understand your point about how nuanced that number is. What I don't understand, however, is how we got to be 76 out of a population of 74. Is that just I don't understand.
It's a percentile, right?
Yeah.
Oh, I
It's exactly, it's percentile, so it's not, when there's less, oftentimes you jump more than one rank. Yeah.
Thank you.
Between the first and the next. And you can see that if you go up and look at the plus 10 billion, there's just not that many plans really that have those types of assets, and so the population drops down to 16, and comparing yourself to 16 others is not terribly meaningful. And they also tend to be quite larger. It's the CalPERS, the CalSERS, the really mega funds that implement in some cases differently and have different resources, both internal and external. So page 34 is the same thing, the same type of information for the severance tax. As I mentioned, the results are similar, although a little bit lower. A lot of that, as we talked about, are some of the nuanced allocations within severance that Landgrant doesn't have, and those have been, at least for the longer time period, a little bit of a headwind. So you see those ranks just marginally lower than on the Landgrant basis. Page 36, and I'll try to wrap up in the interest of time. Page 36, this is a page I really am drawn to because it puts the returns into perspective. I think too often people focus just on the return, but really no attention paid to how those returns are achieved and how much risk was assumed in order to achieve those returns. It's great if you knock it out of the park and you get a 10% return, for example, but if you took 3 times the risk of everyone else to get there, maybe you just got lucky. Maybe you didn't, but I think it's important to put that into context. And this page 36, really tries to highlight and bring to the fore the type of risk that's taken in order to achieve those returns. And I tend to look at the Landgrant total fund composite. You can look at the other subsequent lines as well, but if you look at the top left-hand side, that's for the Landgrant. In the first line on a 5-year basis relative to other institutions greater than 1 billion in assets that we mentioned. And you can see that the median plan at the very bottom returned 6.05, whereby land grant returned 6.29. So you've captured 104% of the median return. The next column over, standard deviation, that's one measure of risk. Not the only measure, but one measure. Really, what it tries to capture is how volatile the portfolio has been. There you can see that the land grant had a standard deviation measure of 5.22 versus 5.89 for the median. So that's 89% of the risk. So you managed to capture 104% of the return with less than 89 or 89% of the risk. So more return with less risk. That's quite attractive. When you slide down to the box below that, that looks at it on a 10-year basis. So comparing the last 5 years versus the last 10 years, and really what that does is it highlights those first 5 years in that 10-year period. You can see the numbers there. I'll just give you the percentages. You managed to capture 107% of the return. So again, more than the median. That's good. But you did so with 102% of the risk. So you had more return but more risk. So what we've been doing, and I think Vince and everyone else has been quite clear, is really trying to keep that return high, but take a lot of unnecessary risk out of the portfolio. And I think this is testament that that's been happening. The last page that I'll spend some time on, and then I'll just make a concluding remark there, is on page 38, looking at your asset class composites. And again, I think the emphasis ought to be on the long term, and you can see those. But in the interest of time, we'll just look at the quarter and what's been working. The U.S. equity composite and the non-U.S. equity composites, so really all publicly traded equities, did very well. When you look at that outperformance, pretty meaningful on the quarter in both asset classes, so domestic and foreign. And the ranks are quite tremendous. I'm sure Starla is quite pleased with those. We see the U.S. equity composite in the 7th percentile, so very, very strong. Top decile, the non-U.S. equity in the 31st. Now again, as I mentioned, there were some headwinds in that space, but the portfolio managed to protect on the downside better than peers and the benchmark. That's quite good. Talked about a little bit of a headwind for core fixed income and the underlying reasons for that. But regardless, ranking in the near median. Non-core fixed income, similar story. Then you have the subsequent asset classes there. Those are not always going to be exactly final, given how those asset classes tend to work. They give you a good insight as to what's been transpiring. Private equity and real estate, both additive. Real return was modestly down for the quarter. I think the only other comment that I'll make is that those asset classes are by and large meeting their investment policy objectives, with the exception of private equity. There's some benchmarking challenges there. The returns are quite good, but by the specific language in the policy, it doesn't meet it for the requirement. And then the other one is one of the U.S. equity requirements you can see on page 41 relative to the performance to the Russell 3000. We know that this is a space that's been exceedingly difficult, large cap equity, or U.S. equity more broadly, to outperform. And so outperformance is, or the underperformance is quite small, 17 basis points. But I think I'd be remiss if I didn't mention it still ranks in the 38th percentile. So very good ranking, and goes to show that everyone has really struggled to outperform the benchmark in this space. I think hopefully that puts that into context. So again, in the interest of time, thanks for being so generous and letting me speak for these minutes. I'm happy to take any comments or questions.
Any comments or questions? Yes, Member Russell.
Thank you, Madam Chair. Can you remind me what the tail is on the real estate and the private equity reporting? Because my recollection is that they're somewhat, maybe a quarter behind or so.
A quarter lag.
So then when we look at these reports, over time, your 3-year, 5-year, whatever's going to accommodate that, right? But this, at any point in time, we're a quarter behind on those particular segments, right?
That's correct. Yeah. So exactly. So for those, and then the reporting takes longer to essentially be right. There's valuation things that just more time intensive. So both the data that comes through in terms of for the fund managers, as well as the benchmark are lagged on a quarter or a 1 month basis for the non-core. So that's always the case. So the numbers that are shown here would be 630. And that's always a lag there. But then there's a further true up usually for year end when there's some additional audits and numbers that come in. So you could have updates historically as well that they get captured when those get released.
So my assumption is when we compare that to our peers, we're still comparing apples to apples because the peers have the same.
Exactly, exactly.
Okay.
Yeah, that's industry standard. There's no way to get that reported any quicker.
Good, thank you.
Anyone else? All right, thank you very much. All right. We are now on item 2D, the National Private Equity Quarter 2. Back to David Lee. Welcome back.
Thank you. As some of the comments alluded to, private equity, we do two different reports, one for the national program, one for the New Mexico program, and it is lagged. So this is the second quarter report, quarter ending June 30th. With that, and in light of time, I'll hand it over to Richard Buckmeyer of Mercer for an accelerated review.
Yeah, I'm just gonna hit on 3 slides and then any questions, happy to answer. But focusing on the performance dashboard for the national program, page 4. So we continue to see this trend of net asset value increases in 2019, really driven by performance in quarter 2 because the contributions and the distributions were fairly even. The 1-year net IRR on the program is 12%, so that's been added to the overall since inception performance. You can see that's increased to 11.6% or 1.49 times net multiple. If you look at the underlying strategies, what's really been driving the performance is buyout and growth, which have both generated returns in excess of 14% net IRR. Special situations, which has a lot of private credit, secondary funds, things like that, that's been lagging, although it's been positive at 2%. And then venture capital is negative at 1.4. But if you'll recall, venture capital in the national program, we haven't made a new commitment in over 10 years. It's really a wind down of a lot of different legacy relationships there. And so we don't focus on that too much. So you can see the rolling 10-year on the graph too continues to increase. 12.6% is the all vintage year performance. Because we don't have a 10-year for those funds that are 2011 and after, we put the return in for the 2009 and before, so you can see how is the recent commitments added to performance. So that difference between 11.3 and 12.6. If you turn to page 7, which is the benchmarking slide. So we benchmark a little bit different than RGK. We look at it by vintage year and look at it on an IRR and net multiple basis compared to the Burgess benchmark. You can see, I'll focus on 2011 and after. For the most part, all vintage years are above median, 2016's top quartile. We do see some variability in the more recent vintage years. So for example, 2015 was 3rd quartile last quarter. It's now 2nd quartile. It does vary because those funds tend to, they're still in the investment period. They're still working with the portfolio companies to generate value. And other than that, no changes. No changes to benchmarking quarter over quarter. And I'll end with page 9, which is the private equity strategy overview. The annual commitment range was $300 million to $400 million. We ended the year 2019 with $400 million of commitments to 5 funds. From a strategy and geography guideline standpoint, we're all within targets. You will see special situations come down as we haven't really made new commitments in that area, and you can see that because of performance, we're focusing on those areas with more compelling return opportunities, which is buyout and growth right now. We do continue to look at venture capital too for the national program. The challenge there is getting access and getting a sizable allocation to a fund, but we continue to look there. From a concentration standpoint that was mentioned earlier, you can see there is one manager that is greater than 10% they're generating a 14% net IRR across all their funds, so that's been additive to the overall portfolio. Where the guidelines really come in handy is when we're looking at new commitments and we're trying to size it. It really prevents, looking at, what do they have on the realization front? Are they going to be returning this capital soon? Is there uncertainty there? And then sizing the commitment appropriately when we bring it to you so that we don't end up with an exposure problem in 2 or 3 or 4 years down the road. So that's where the guidelines are really, really helpful. We have been concentrated on the managers. We've made commitments to 24 managers since 2011, so we have been fairly disciplined on keeping the manager count small and releasing investments, although in your portfolio there's still quite a bit of funds, 114 active funds, which we continue to work with to try to find liquidity. You may have heard me in past performance presentations talk about the lack of distributions, which is one of the things that we were looking at. Q4 distributions have really come in. We're already at over 100 million of distributions in Q4 through kind of the latter part of November. So it'll be interesting to see how December looks and how we'll report that in the future. But I will end that with the national program and happy to answer any questions.
Questions from members? Anyone on the phone have any questions? All right, thank you. Let's move on to the New Mexico private equity. Q2.
And I think that Richard will start on slide 117.
Page 4. Just as a reminder, we do categorize the New Mexico program a little bit differently because it's almost all venture capital. And so we do it by investment type. So you have the fund investments, the co-investment funds, and the catalyst fund. The similar themes that we've talked about in prior quarters also still apply this quarter with the New Mexico program. You do have a large exposure to the co-investment funds. The co-investment funds themselves are concentrated in a few number of investments that we continue to watch. Similar to the themes I've been watching on the national program, there has been a lack of distributions, which given the age of the portfolio, we'd like to see more distributions come in for this program, especially given the strength of the capital markets. And then there's been the lower performance, 2.2% since inception. Although when you look at the more recent performance, which is the table down below, you can see that the rolling 10-year net IRR has been improving, and we're at 6.6% right now. Turning to the benchmark page on page 7. So this is a little different than the national program in that we benchmark it to other venture capital funds, given the concentration of venture capital. You can almost draw a line right after 2005, though, and look at the performance kind of past 2006 and after. You'll see on the net multiple side, which is the right column, all of those are second quartile. The net IRR, there's more variability where some of them drop below median. So what that implies is you're getting the value above median, but it's taking a little bit longer to get it than other venture capital funds have been able to generate. And we've seen longer hold periods in the New Mexico program, but given some of the concentration that we have and some of the liquidity events that look like are coming up, this could be actually pretty variable, both to the positive or negative. And so we continue to watch that and see how the rankings are going to change. And then the final thing I'll hit on the New Mexico program is the economic impact update on page 14, because this does have a double bottom line, both performance and return. So we get this from the fund managers quarterly. We'll go out and survey them. There is 73 New Mexico-based companies that have received investments, and we actually break that down to both companies that are in the portfolio currently, that are actively owned by the funds, and then also companies that have been either sold or written off. So the fund managers actually don't have any more involvement in those companies. There's been 3 companies funded over the last 12 months, and this is 3 companies that are new to the portfolio. We don't count follow-on investments in that number. We count new companies into that portfolio. From an SIC level, there's been $267 million invested in New Mexico-based companies. And then when you take that to the fund level, And just to give you an example, so if you have a fund in the New Mexico program that invested 10 million in a New Mexico company, if you're 10% of the fund, your portion is $1 million. So that's what the SIC level number is, would be the million, and then the 10 million would be included in the fund level. And since there's a requirement to invest in the program, I think it is valid to look at what is the fund level invested into the state of New Mexico, and you see that's about 361 million that's been invested, with about 25 million invested over the last year. 3 companies have moved out of New Mexico, so that's another thing that we track is, are they still in New Mexico, maintaining some type of presence. We also track companies who received government incentives as well, which the number is 20. And then if you turn the page, we look at jobs. And the way we do it is the companies that are sold we actually kind of freeze the number to whatever the most recent number was, because the fund manager doesn't have access to the management of that company. But what we hope is after they're sold, that those numbers will actually keep growing. So in some ways, the realized number is conservative. We just don't have a way to actually get those numbers anymore, since it's not owned by the fund managers. And then the ones that are still in the company, you can see that there's 790 jobs, total 1,168. We also look at job growth, which is how many jobs have been created since the initial investment was made by the funds, and that number is 411. The annualized payroll for New Mexico-based jobs is 88.4 million. So if you do the math, the 88.4 divided by the total, it's about $75,000 a year is the annual salary. And then we also asked them about annualized expenditures in New Mexico, and that number is 39.7 million from that economic.
And one of the big questions that came up in the CIC is why do you differentiate these columns as you do, with a column for currently held in funds unrealized versus sold written for funds realized, and then totaling them. And that's specifically in place because there's an information disparity between the 2 columns. I think Richard kind of referred to the fact that once a company is sold or written off, probably not written off, probably sold, they may move out of state, but they're not under any requirement to the fund manager and therefore to us to be periodically reporting these numbers. And Richard made a comment about it possibly being conservative, but we differentiate between the 2 because that last column, sold, written off, is somewhat older information because there's really no way to force these companies that we don't have any ownership in to provide this information to us on a basis.
You said those funds the jobs were like 75,000?
Yeah.
And so does that include benefits and all that stuff too? So they're really making about 50 grand a year? Or
We asked payroll, so whether it's included, most I think would include benefits in payroll. So yeah, that would include benefits.
so you're looking at about a $45,000, $48,000 again.
On the benefits, true.
Okay.
Thank you, Senator. Any other questions or comments, Senator Wilson?
Yeah, Richard, could you explain to me the difference in the chart on our page, it's your 2 pages 8, on the national and the New Mexico, page 8 on both of them, which in our case is page 94.
Oh, yeah, public market go.
Because we have not, I'm not arguing about I'm talking about the index numbers, because your index numbers are different.
Yes, yeah.
So they both seem to have the same 10-year period.
Yes.
So why the difference?
That's a great question. Yeah, so the other benchmarking we do is called public market equivalent. It's because the public equities are typically reported on a time-weighted basis, basically equally weighting different time periods. And private equity is reported on a dollar-weighted basis. So when is the capital drawn, when is it returned, what's the valuation as of the measurement date? They're not really an apples-to-apples comparison. And so the way that we compare to a public index is do a public market equivalent calculation. So we take the cash flows from the national program and from the state program, and invest it as if it was in the public benchmark. So when there's a capital call, that goes into the benchmark on a hypothetical basis. And then when there's a distribution, there's a sale from the benchmark on a hypothetical basis. And then there's some amount of shares at the end that's valued at whatever the benchmark is as of June 30th. And so because the cash flows are different, that's why you're gonna get different numbers between the state program and the national program. Because it's basically calculating a net IRR using the public indexes as the performance benchmark rather than just looking at the private equity funds.
Think of it as buying an index when they draw money, and then when they sell, selling that index. And the timing of those cash flows are gonna be different between the national program and the regional program, which is why the 10-year number can be different.
Got it. Thank you.
Any other comments, questions? All right, thank you, gentlemen. Moving right along. We've got 2E, last performance report. You've got William Mercer, the New Mexico Private Equity Q2. We did here, I thought excuse me, I keep walking out, I apologize. My mom fell. So I'm working on making sure she's okay, so I apologize. So I have to keep doing that. The secretary will cover me. I like you all, but I love my mother more. But I think she's gonna be fine. We are in 3D.
So we are in 3D.
We're in 3D. It's a good thing that the rest of you.
Governor Council, today, we're just bringing forward a co-invest, which is just an addition to an existing infrastructure manager that you have already all approved in February. Please just follow along with me as I'm going to bounce around a little bit between the co-invest, give you a quick high level, again, of just what exactly Brookfield does, just as a quick refresher, since it's already been approved once. And then we'll go ahead, Jack and I will go ahead and just give some more details again on the details of the co-invest. So in February, as I said before, we made a $100 million commitment to Brookfield Infrastructure Fund 4. This goes in the real assets portion of our real return portfolio. Staff, in consultation with Townsend, recommend an additional $50 million commitments in the form of co-invest. And so this recommendation is very analogous to one we made just a few months ago, where we made a $50 million additional co-invest to BlackRock Global Energy Partner Infrastructure Fund 3. That was in June, and this is a very similar move. Again, a very similar repeat, just similar, but different manager. So this co-investment commitment will provide New Mexico State Investment Council with the opportunity to partner with what is one of the largest infrastructure managers in the world. They currently have over $100 billion in assets under management within infrastructure on a no management fee, no carry basis. So there will be a 50 basis acquisition, 1.5% acquisition fee to help fund all the fees that go into actually buying these companies that they're buying. What does that really mean for context of getting no management fee, no carry? Essentially on anything that we are able to do within this co-investment program, they are targeting a 10% net return on their fund. To get a 10% net return after management fees and carry, they typically are going to get to approximately 13% gross return. So for the portion, if they go get a 10% net on this investment fund and a 13% gross, we actually get the 13% gross. And that becomes our net for this portion of the fund. So obviously it's subject to any individual investment, but we basically are saving 300 basis points on a successful investment if that goes forward. As I mentioned, as BIF for Brookfield Infrastructure Fund 4 is a previous investment, I'm not going to go too far into the weeds on it, but I will give you a quick high level. Townsend has attached their full write-up that they provided back in February, and there's more additional info on that now as well. So Brookfield currently targets, as I said, a 10% net IRR, 13% gross. They target primarily cash flowing assets. So they're one of our more conservative investors, so they'll go get a cash flowing asset, and then they'll make some existing improvements to that asset to increase cash flow, often improve the balance sheet, get cheaper debts, improve organization optimization. And in so doing, they're generally paying out 4 to 5% dividend throughout that term. Unlike some of our other funds that are maybe doing a greenfield approach, where they're going and building something brand new, in which case you have a long drawdown period before you're having any cash. That would be an atypical investment for Brookfield. I'd also just like to mention that Brookfield, in their predecessor funds, has typically, they've had no realized losses. So any of the companies that they've actually bought and then ultimately sold, they just go to realize with private equity. No realized losses, and only one transaction of theirs is actually valued in all of their prior 4 funds at below cost. And that is due to currency impact. If you actually look at it in local currency, it's positive. So all their investments in their funds so far, going back to Fund 1, have been positive investments. And so that's another reason why we like them. To move back specifically to this co-invest, they're going to have a 4-year remaining term on their investment period. They're just about to close the fund. At the end of their closing, they have a 4-year investment period, which means a lot of things can happen within the next 4 years. As such, we're requesting that staff would remain flexibility for just an opt-out to basically say no. Where would we say no if they came to us? It would be on purposes for portfolio allocation, or for some reason the market shifted and Vince wanted to have that money in equities. It wouldn't be because we didn't agree with their underlying outlook or underwriting on any specific investment. A really easy and quick example that we use at the CIC would be what happens if all of the MLP money, which we currently have in midstream, were to do what we are all hoping it to do and run up in price. In that case, we may sell a portion of our MLP proceeds, reduce our midstream exposure, but until that day, we would probably say no to any new midstream businesses that came in, if they came in the form of co-investment, because we're already over allocated, or at least, let's say, rightly allocated to our midstream investments. Similar to prior co-invest, there would be a maximum amount of underlying commitment per deal to help maintain some diversification. So we would put no more than $25 million into any one individual co-invest on a commitment type basis. Lastly, the suggested commitment conforms to all policy, manager, exposure, and diversification limits. Jack has anything else?
I would just add, just so that everybody has understands what we're talking about, the co-investment sleeve sits aside of the regular fund, and so any investment that Brookfield is going to make is going to first come from the fund itself that you all are already part of, and then anything that if it's too large from a concentration perspective to the fund, or they're looking at concentration limits that they already have in the fund, they would then draw capital from the co-investment fund, which this $50 million would be part of. So there is a waterfall of investors based upon the size of commitment that you make as a first fund, how much capital, they'll start with the largest investors and draw their capital first and co-investment, et cetera, but then ultimately get down to other investors that are in the fund, such as yourselves. So it sits aside, and in those larger transactions or transactions that would reach the fund of a certain geography or sector concentration limit, that's when the co-investment fund is utilized. Otherwise, Clay did a great job explaining everything else.
Any questions or comments? All right, seeing none, I think we're ready for a motion.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor at Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $50 million to Brookfield Infrastructure Fund for co-investment, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Remember, Addison, we made it sound by Mercer, it's by town. So we need to adjust it.
I was thinking, yes, so I will so amend it.
Do I have a second?
Second.
Second.
Okay, time seconds by the two senators. Any questions, comments, concerns? Hearing none, all those in favor say aye. Aye. Any opposed?
Aye.
Anybody abstaining? Motion carries. Thank you.
Thank you.
Okay, let's see if I get a break.
I have to excuse me, I've got to take my daughter to the hospital.
All right.
See y'all in a little bit. Thank you.
Thank you, Senator. Thanks for participating. We are now on item 3E, requiring a vote. It's action item. We're going to have me and Mercer present New Mexico Private Equity, the Anzu Industrial Capital Partners.
Thank you. We're here with Richard Pugmire again from Mercer, and also co-founder and managing partner at Anzu Partners, David Sullivan. I will just make some quick introductory remarks, and then I'll just turn it over to David. Anzu Industrial Capital Partners 2. This is an early stage venture capital investment strategy for the New Mexico program. They target investments in companies developing advanced technologies with industrial applications in hardware, software, materials, manufacturing systems for life sciences, and this is primarily based in the US and Canada. Anzu has 11 investment professionals, 18 business services professionals, and 13 part-time employees, which include venture partners and advisors. They currently have 4 offices, Boston, San Diego, Tampa, and Washington, D.C., and they are considering adding a 5th. The fund expects to make 16 investments in Fund 2. They've already made 5 of them because the first close for this fund was in March. The initial investment size for this fund will be $3 to $8 million. It will average $3 to $8 million. It will be a $20 million maximum, and that includes all follow-on investments. Target size for Fund 2 is $150 million, and the hard cap is $190 million, which is raised from $180 million. And for perspective, Fund 1 raised $128.4 million. The GP commitment here is $10 million. They have some favorable terms in terms of preferred return and waterfall, which we like. This is a newer fund. The track record is limited because Fund 1, the vintage year is 2016. Staff is recommending a commitment of up to $10 million in Fund 2. Forgot to mention that all these materials are on diligence. The Mercer recommendation starts on page 211, and the Anzu presentation starts on page 261. With that, I will turn it over to David.
Thank you. Thank you very much, and Governor and assembled team members. It's a pleasure to be here and appreciate the possibility of becoming part of the New Mexico State program. We're very excited about what we're doing at Anzu Industrial Capital Partners. We are not a Silicon Valley investor. We're not a Greenwich, Connecticut investor. We are a all over the US and Canada investor. We have portfolio companies in Philadelphia, Toronto, Omaha, San Diego, Denver, Raleigh-Durham, and Albuquerque. We'll talk about that in a moment if you'll allow me. In addition to a number of portfolio companies in the Boston area and in the greater California area. But we are not 5 minutes from our office investors. We're seeking out what we consider to be breakthrough industrial technologies. Our focus is narrow and limited only to that. So let me spend just a few minutes on what we mean by that. Breakthrough industrial technologies. Breakthrough. We're not incremental investors. We're looking for things that are transformative in their industries, things that allow you to make a material you can't make any other way, or a process that can't be completed any other way, or if it's something that exists already, something that changes the cost structure by, let's say, 50%. So not something that you have a little improvement and you financially engineer it into a big financial return. We're looking for big breakthroughs. Industrial. We focus only on the industrial world. So we invest in companies whose customers are big companies, typically the global 200 industrial companies around the world. So we're not looking for an app that might go to 1 billion people or a piece of software. We're looking for real things in the real world that make a difference to Boeing, Siemens, General Motors, Toyota, Panasonic. And those are all real examples of companies that our portfolio companies are in business with. Last word, technologies, breakthrough industrial technologies. We're not a science investor. We will never knowingly expose your capital if you invest with us to science risk. And by that I mean someone who thinks they have an idea or a breakthrough that they haven't proven yet. We invest only in things where we can diligence the invention, and then we back those teams with capital, but more importantly, with human capital from the 30 odd people on our team to help them move from an invention to a product to a market. One of the members here this morning talked about the need for supportive companies. That is our model, in fact. We have a very significant team, about 30 people, and our model is to embed those people deeply in our portfolio companies and work with them. Some on the investment team to help them refine what we call product market technology fit, which is taking their invention and designing products that really matter in the big global ecosystem. And also people on portfolio support. Most of our portfolio companies don't have or shouldn't have a CFO. They shouldn't have a communication staff. They shouldn't have an IP lawyer in-house. They shouldn't have a manufacturing expert, but they need all those things. They need them in small quantities or in big quantities, but they can't afford them. What we've done is bring all those departments in-house with really exceptional practitioners, people with 20, 30, 40 years of experience, and we make them available on an a la carte basis to our portfolio companies. So it lets our portfolio companies from maybe small 8-person teams working in a small office to have the punching power to be able to go up against the General Motors or General Electric or Panasonic in a negotiation over IP. So that's the essence of our model. We think of ourselves as investors in picks and shovels. We want to invest in the enabling technologies that allow for huge breakthroughs. So for example, in life sciences, we won't invest in a therapeutic. Brilliant advances are being made in cancer, and for every company that succeeds, there are 100 that are complete wipeouts. We don't want to expose your capital to that regimen. We look for companies that create the tools that allow for cancer research to take place, so that while drug A may work or drug B may not, our portfolio company is serving the ecosystem that allows for the development of those types of drugs. One of those companies is a company right here in New Mexico that we're deeply in diligence with. I guess it's on the public record, so I won't name the company, but we are very close to making an affirmative investment decision with this company for a very large capital allocation. It would be an $8 million investment in a company that's a spin out of Los Alamos. Part of our excitement in the prospect of becoming partners with New Mexico is that we see New Mexico as a very, very deep, untapped area of scientific and technological entrepreneurship. Things like Los Alamos, we have another portfolio company that's working with Sandia on a project, and I'm delighted that we recruited to a board position in one of our portfolio companies, Charlie McMillan, who many of you may know was recently the director of Los Alamos. But again, we see the New Mexico environment with very talented, very deep science and technology backgrounds as a fertile ground for us, and we would look to advance our investment opportunities in New Mexico. We have one portfolio company, as I mentioned at the outset, that's already located here. We invested in a company called Zeteo, which is a leader in chem biodefense. They have 2 offices, one in Sykesville, Maryland, about an hour outside of DC, and the other here in Albuquerque, where the company's co-founder, Chuck Hall, is based with his technology staff. And Chuck actually has been an advocate for us getting more deeply involved in the New Mexico economy, and was part of the reason that we're diligencing this other company that I referred to. So we're delighted to be considered for an investment in New Mexico, and we're actually deeply interested in pursuing investment opportunities here. Again, we see it as a deep market of opportunities that we think has not been sufficiently attacked by the venture community. We'd be delighted to answer any questions that anyone has.
Thank you very much. Yes, Member Messina.
Yeah, I'd like you to elaborate on a couple of things. Number one, you talked about some of the scientific, technical people within your organization, and so I'd like you to explain a little more, because I know you have a lot of extraordinary people with these qualifications, but I want you to explain not only what you have, but how they interface with the companies that you look at and fund. And also, I'd like you to describe what participation and relationship you have with these companies that you fund with respect to management as you go forward.
I'm not sure I understand the second question, but let me try the first, and perhaps I'll try the second. So we have, in our staff of 30, we have 2 MBAs, and they're myself and one of my partners, David Michael. Literally everyone else on the investment team has a PhD. So for example, the company that we're diligencing here in New Mexico, the person who's leading that effort with me is John Ho. John is an MIT PhD. He had spent a couple of years at the Boston Consulting Group, spent 5 years at a startup that was subsequently acquired by Samsung. He has deep technical knowledge and experience. His second chair on that diligence is a man named Tayo Sanders. Tayo recently returned to us after completing his Rhodes Scholarship. He has an undergraduate degree in hard science and then a PhD from Oxford in biomedical engineering. So those two folks have been sort of my team diligencing a deep science company here in New Mexico that frankly I'm not qualified to diligence, but my team is, and I play the role of integrating their scientific deep insight into business insight with them to reach an investment decision. That's typical of our team across the country. In San Diego, we have a man named Jimmy Kahn. Jimmy is a PhD metallurgist or a material scientist from UCSD. We hired Jimmy because we hired his doctoral advisor to be an industry expert on a previous company diligence. And this fellow called us up about a year later and said, you know, the smartest PhD student I ever had is at Qualcomm as an engineer, and he's bored. You know, I think you guys might look at him. So that's typical of how we find people. There's a competition about who's the smartest guy in the firm, or smartest person. We have a pretty diverse staff. That competition's in my mind, not on the battlefield. Our folks work together collegially. But we have this extraordinary team, very rich in PhDs, and young folks as well. You know, our average age of our investment team is in the early 30s. So we have energetic, brilliant scientists, such that, for example, in diligence in the company here in New Mexico, our team flew in and sat at the bench over a 36-hour period with the scientists to run the experiments and participate in the actual science and see it work. And they were able to be discerning to know if it worked or not. So we're not the typical sort of MBA-rich firm that's looking only at industry reports and business reports. We have a deep technology bench that gets deployed into these companies. In terms of how we work with the companies, that was your second
Yeah,
question.
really, after you fund them, or even before, on the non-technical side, what kind of participation do you have with them as you're looking at your prospect of investing with them, and then how do you interface with them after that?
So we won't make an investment with your capital where we're not on the board of directors. Typically, we are at least one seat on the board of directors, almost always the lead director in these companies. And we split that up amongst our partners and some of our senior staff. But beyond that, and more importantly, our team gets embedded in these companies. So the diligence team that I mentioned, John Ho and Tayo Sanders, they'll work with this company in New Mexico hand in glove for at least a year, tuning that company's technology to the market. Again, what we do is we look for companies with solid inventions, and we help them engineer those inventions into products. People talked before about the skill sets that inventors have. The skill set to invent, that genius moment of inspiration, and the skill set to engineer that invention into a product, two different things, sometimes found in the same human being, usually not. So we have a team of people who are able to be deployed to help that process, to literally work with the portfolio companies in engineering those inventions into products. The team that did the diligence for us will be deployed here, I would guess will be here at least once a month. Some of these folks will be here for days a week, working to fine tune that. And then we have, for example, a full accounting department based in Tampa, where for about half our portfolio companies, we actually provide the accounting services for them. Again, because their choices are hire an internal accounting department, which is expensive and inefficient. Go to a third-party provider, and without denigrating third-party providers, those people are in business to make money selling accounting services. Our team in Tampa is in business to help our portfolio companies succeed. There's a big difference, and a big difference in pricing, and a big difference in quality of work.
Thank you. I also want to add, I appreciate your comments about looking more at New Mexico because of there's a tremendous amount that comes of technical transfers that come out of both labs. And those things have not been exploited in the state. I think there's great opportunities. I thank you for looking at it. I encourage you to do even more.
Any other questions or comments from members? All right, seeing none, I believe we're ready for a motion.
I have a comment question.
Okay, Member Frank?
I'm very excited about this opportunity in this company. I am surprised though at the fee arrangements. They seem so far out of line with what we have been paying and seem to be going the wrong direction. Is there some reason why you would agree to such a substantial fee increase?
If you're referring to the management fee, is that what you're referring
I'm
to?
referring to both the management fee and the carried interest, as well as the expense allocations, all of them.
Okay, well, the carried interest is typically, it's market, except that they actually do have a preferred return, which with a lot of venture capital funds, they don't actually have a preferred return, even though it's recommended by Oakland principles. And part of that is they don't want to be under this gun of having to sell something to get a preferred return. So we think having that preferred return is a good alignment factor with ANZU. On the management fee, we look at the management fee on a fund-by-fund basis and not kind of a universal basis. The 2.5% is at the high end of what you'll usually see of a fund that we bring. It is more common with venture capital because with venture capital, the funds have smaller sizes. They're not the multi-billion-dollar funds that you typically see on the national program side. We saw a 2.5% there. We would have a strong question on alignment, but they're keeping their fund size small at 180 million, and you can see the size of their resources. They have a pretty substantial investment team, which we liked, and then also on the business services side, the other thing that Member Frank referred to was on the fee offset, which I think it's good for the council to be aware of. Normally, what we see is 100% fee offset for things like directors' fees, etc. But what you are seeing with a lot of different private equity firms out there, most recently I think you saw with Vista Equity that we brought here, where they're finding it more efficient to have the knowledge internally to help their portfolio companies. And so they develop their own internal resources and have the portfolio companies pay for that cost, rather than going out and hiring a third-party consulting firm to do it for them. And that's how ANZU has set this up. They have the portfolio companies paying for those services, whether it's accounting, whether it's marketing, website design, just in place of what they would normally pay somebody else if they were to just go out and hire it.
I might add that we lose money on every one of those departments. They're not profit making. We seek to have some level of cost recovery, but they're there to help the portfolio companies succeed.
I think I hit all the terms. Did you have any other questions on?
And the carry is market for buyout and growth. It might be actually a little low for venture, for higher achieving venture. There is a step up, but that step up only occurs once they reach a much higher.
Right, I saw that. I don't have any problem with the 20%, the 30%. And, your report this morning suggested, for example, that we should be looking at 3, 4, 5 times on a successful company. And in this case, that would imply to us a 30% carry. I just been really troubled by it.
You see it commonly with venture capital because it helps incentivize, well, the really good venture capital funds will actually have a higher than 20% carried interest right from the start. But we like it having a step up because, if they get a 3 times return, it's going to be one of the best performing funds in the New Mexico program. And we will be happy with that.
Any other questions or comments? Okay. All right.
Based on the recommendations of the Council Investment Committee and Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $10 million to ANZU Industrial Capital Partners 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do I have a second?
Second.
I have a second by Secretary Padilla Jackson. Do I have any further comment or discussion? Seeing none, we'll call for the vote. All those in favor say aye. Aye. Any opposed? Any abstain? Hearing none, the motion carries.
Member Lavender, had to recuse himself from the investment committee. I believe he's off the line now. Excuse me.
So the only person we have on the line right now is Member Frank for counting votes, correct?
I'm on the line, that's correct.
Good, okay, just making sure that we're tracking. Thank you, Member Wright. All right, thank you. All right, 3F, last action item, besides adjournment. It's, you're welcome, it's telling you that the item is inside, I can see it. 3F, our investment policy statement, we've got Smith and RBK back up.
So we're between you and adjournment. We'll move as quickly as we can here. And by that, I mean your investment policy is very important. Don, is a very important thing to spend some time with. We routinely update this for you. We tend to do it in pieces, so you'll see an update to the private equity section, the real estate section, we may tweak so forth, so on. But we haven't taken a broad look at the general investment policy for quite some time. So that's what you're seeing. It's almost all the things in there are just simple updates from how we were managing in 2012 or 13 or 14 or whenever that latest policy is until today. So not a bunch of structural changes to the policy, but mostly updates. And Marcia is going to take the lead.
Thank you, and I will go through this pretty quickly, but please ask questions. And I'm hoping, I was just looking at the page numbers in diligent versus, some of these might not lay out exactly to my notes, but I'll try to point this out. I want to just begin by saying that this came to the investment committee, the council investment committee on October 10th. And again, with getting their feedback on the 10th, we brought some revisions and additions to the CIC meeting on November 14th. So it's been in front of your investment committee twice, and great input received. In general, we've made some asset allocation changes over the last few years, and we need to get those into policy. The land grant and severance tax has been a couple years ago, and then, as you know, we've made other allocation changes and added a couple funds. Now, the governor signed a House bill, and we now have oversight of the Tax Stabilization Reserve Fund. We also have added the rural libraries endowment fund, and thanks, Brent, for giving me the exact titles for those two funds. So we added those. So on your page, diligent page 338, you can see that we referenced under investment authority that you had investment authority over those two funds. On your diligent page 339, thanks to Charlie, we have a paragraph on each of the new additions, both of the new additions. I don't know if you have any questions about those, but Charlie told the language. And on 339, it's on the bottom of my page, there's a paragraph that begins as provided by law. We made a change to that. You can see it, we said including rebalancing activities. This is in reference to what we call your agency accounts or your external clients. They make the asset allocation decisions, decide what funds are going to go into. If they want to make transactions or moves, it's their responsibility, including rebalancing. So we just wanted to make it clear that they're responsible for rebalancing as well. Okay. Just referencing, going on page of diligent 340, just a general comment, you'll see throughout that we made changes to investment staff. So throughout the IPS, the naming convention was updated from internal staff to state investment office investment staff. In short, SIO investment staff. So that's throughout the document, just giving clarification there. Also on page 340, you'll see highlighted, we updated the list of fiduciaries to include the council investment committee, the CIO, and the State Investment Office investment staff. Then we're going to go to 342, and this is the formal review agenda for the policy. A couple of additions were made there. We added the Council Investment Committee charter. That will be reviewed at least every 3 years. And then annually, Vince referred to it earlier today, your State Investment Office investment plan, so we added that to the review schedule as well. At the bottom, at the bottom of that page for me, you'll see that we struck ensuring and added seeking. We just wanted to soften that language a little bit to say seeking rather than ensuring. When you see on page 343 of diligent, you'll see green. When green is something that wasn't taken out of the policy, it was just moved, so you'll see some green double line there that was just removed if we felt that there was a better place for it. And also you'll see red underline. We sharpened up the language for council responsibilities with statements like you'll see in the second full paragraph. The New Mexico State Investment Council is responsible for the strategic direction of the investment of funds. Just kind of sharpening that language there.
Absolutely.
To the next page.
Oh.
Because I didn't understand why you placed in there best-in-class investment practices and took out the operating ethically. I mean, is there a reason for that on that page, your page 9 or 343? In the second paragraph, it finishes there with best-in-class investment practices. And then in the next paragraph, you also take out again best-in-class investment practices, but then you, you're gonna put there. But then down here, you've taken out the operation, operating. That first line, manage New Mexico's current funds ethically.
I think that is just part of the moving it around.
Is operating ethically.
Yeah. No, it's just the first time. Thanks, Kevin.
Thank you.
And thank more to
Should
Tracy
work.
because she explained what I was trying to do.
Yeah, all clear.
Going back to the top paragraph and now on the page 343, we softened the language there from saying excellent, prudent investment performance to competitive investment performance. And then we referred to your mission statement. Your mission statement is at the very beginning of the investment policy. We just thought it was a better fit to reference what your mission is. Under Council Investment Committee, we added references to the CIC charter. And now the charter is part of the investment policy as an Appendix A. On 344, under State Investment Office investment staff, we added language related to the CIO's responsibility to direct and implement decisions required to achieve the council's strategic investment direction. And then we're going to skip a page, and we're going to go to your diligent 346. And this really, this page and the following other 2 pages really reflect the council's asset allocation decisions that you've made over the last few years, as well as adding the tax stabilization fund and the rural library endowment fund. So we updated asset allocations and added those 2 funds. And on 347 and 348, it's the same thing. We just updated the ranges, the target rebalancing to reflect the new asset allocations and added tax stabilization reserve and rural libraries. On 349, again, there's some language that was removed, but in the middle of the page, the one paragraph that begins, the New Mexico State Investment Council has delegated. We changed from the staff is responsible to the council has delegated. to this state investment office to do rebalancing. You set the policy targets and ranges, you expect them to implement your decisions. And then at the bottom of that page and onto the next page, there's really just some clarifying language on asset class structure. Really focusing mostly on your diligent 350, clarifying language for asset class structure, and then staff and consultants will structure and staff will implement the assets classes based on your benchmarks. You have set the benchmarks for these asset classes. They will structure, we will structure them and they will implement to reflect those benchmarks. Second, asset class performance versus their benchmarks will be reviewed monthly and quarterly. We do that each meeting. And third, the asset class structure reviews will be provided at least every 3 years. So again, just clarifying and putting in policy that you're going to look at your asset classes. You really want to make sure that they're reflecting the asset allocation decision. They're behaving like you modeled them in the asset allocation process. Okay, we're going to skip up to 353. Just a change here, the paragraph that begins "and investment." This is really addressing monitoring and not termination of managers, so just some clarification there. And then if you go to page 354, at the very top, we changed that from prefers to will, and then this is in reference to if there's going to be a termination, you want documentation to support that decision. Below that, under policy benchmarks, again, reflecting the new asset allocation decisions that you have made as a council and also adding the two new funds. And on page 56, just again, bringing in that you've delegated transition management, how to transition management to staff, but the council still selects the pool of transition managers. Below that, under permitted investments, you added REITs to both U.S. and non-U.S. On the top of 357, you added low duration. Two of the funds now have a low duration asset allocation, and that is both the tax stabilization and rural library. So it's an added asset class. So we needed to reflect that in permitted investments. Page 359 just added distressed debt under private equity. It had not been in there before. And then on 360, under general investment restrictions, bumping up no more than 7% of cost and 10% of market from the 5% of stock. And based on some feedback that the investment committee chair provided, we added publicly traded, so this wasn't confused with anything in private assets. So that change, and then below you can see also the same changes and a higher percentage for securities representing debt and equity of the company. And I think the next is on page 363, and this was a recommendation from Evan. That, for example, you've implemented your asset allocation changes, but the policy had not been updated. So it says if the council makes a decision, that decision supersedes this investment policy until the policy is reviewed. And then you'll notice on 368 that we added the investment review chart. Oh, yes, you didn't. Let's go back to 361 and your guidance on, we left this highlighted, kind of skipped over that. I apologize for the ETIs. That language based on the decision that was made today will likely need to be revised. 362 in the document, sorry. So this is an action item, but based on what we need to revise this language based on the decisions made today to the private New Mexico investments.
Yeah, I'm reading the bullets, too. I don't know that it's restricting you from doing what we just decided to do earlier in the day. Am I reading that right?
We just wanted to point it out as.
We just have one question, Governor.
Yes, Mr.
Why
Turner.
did we go from 1 year of electing a chair to every 3 years? Is there a reason for that? I mean, electing a chair.
For the investment committee?
Committee would take 5 minutes, maybe a minute and a half. Don't you volunteer and everybody says great?
We've been very loose on this, and we thought, oh, man, this needs to be added to our agenda, and we have to calendar it in. We thought 3 years, that provides some continuity for a chair to kind of get have the routine set up is what they want to do. If you want to do it annually, it doesn't matter, it's just that we haven't even had a governance committee meeting for a while because we don't have a governance committee. We've been, and that I think is worse than worrying about whether the chair is 1 year or 3 years. I think changing it every 1 year is going to be.
It doesn't mean it has to change.
But it's not that I'm hogging this thing. I'm happy to pass it forward.
This is more of a pet peeve on all the other boards and commissions I sit on. We had a chair once that was chair for 20-something years. And so we initiated a policy that after 3 years, that we should change chairs, just so you change direction and change thinking. Sometimes it doesn't change, but just so one person isn't doing it, so to speak. And so, would you meet me halfway and would you go to every 2 years?
Well, it was really tied to the schedule. We added the investment committee charter review every 3 years, so we just made this a 2 year too. That's a simple answer.
That part doesn't matter. I certainly don't want a provision in there that says you can only be it for a certain amount of time. I don't want to do it.
Senator Ross.
Never want to be
Yeah,
chair.
that's right. Determine what we're going to do with the treasurer's statement that Senator Ross made.
The challenge you also have is the fact that members are appointed by different appointing authorities.
Oh, right, I'll make all the appointments.
Right, but you don't know as you change, our terms are different.
Correct.
And so you can have say a chair then that has a 3 year term, but only has 1 year left on their appointment. So I just think it's more sense to just, like the treasurer says, it takes 5 minutes to put on the agenda. But we should be doing that with the vice chair, we should be doing that with all positions. We should be reviewing it annually and say, yeah, this is how we keep going, because we don't know what the terms are. Now, you've got 7 more years and hopefully.
That was good. You made up for
Hopefully you'll maybe after 7 years, right? So, but I'm just saying in general, she may term out, we may not term out. I don't know who's going to, but anyway, I'm just saying, it's just more practical, I think, in a 1 year. Of course, we could all die tomorrow.
So, and he was off to such a fine start. On that note, maybe the easy thing to do is we should be cognizant that what we're looking for in position elections or votes, that we want some continuity because that's valuable and important, but we recognize that we should be inspired to do that activity annually. So it's a reaffirmation of who's leading and why. And I don't see that as being a huge substantive change, kind of a friendly, if you could rework that language, I would trust that they would get it right. Does that fit with this recommendation? So we would vote on leadership and committee chairs that require a vote annually, and we would recognize, you could put that in there, that one of our goals in those elections is to look at continuity of leadership so that we, for all the right reasons, so that you stay the course on issues that are ongoing.
Is it a review or you actually elect?
The way that they're talking about it is, I think that it's a reaffirmation, so we would elect annually, and I agree, it just.
And Madam Chair, in
Yes.
addition to the investment committee chair, is the vice chair of the SIC also listed as annual?
Yeah, I was making it broad, so that every position that requires a vote would come up for a vote annually. Does this mean that I don't have to be the chair?
No.
Oh, you guys are no fun. Our blood sugars have dropped to the lowest possible level, and I'm concerned about that. Remember,
Even members on the committee are elected. So does this mean that we annually elect members and chairs of investment, audit, governance? This ends up being not 5 minutes.
No. But since I'm not on the governance committee.
So,
We're on the go.
yeah, Director Moise whispered in my ear that we could, this is something the governance committee could take up, and maybe in the policy, subject to the recommendations of the governance committees, how we'll proceed with elections. So that you can finish the report, you can approve it, but we recognize that the role annually is through the governance committee to decide who we're electing and who we're not electing. Annually. Does that work? Okay.
So that works for me.
Okay.
I had a question, just if your staff thinks that our ETI language after today's action on the structure study is not compatible. I mean, that's the first thing that was brought up.
I think they thought that it was broad enough, but do we want to make it a fair question? We want to make sure that what we have in here reflects the current policies.
Yeah.
Anyone on the staff that thinks it doesn't, give us the,
I don't think
generic
it's,
enough.
Governor, I think it's broad enough. We anticipated a discussion on it, but if you all see it as broad enough, more board.
I do, I can't speak for the group. I want to make sure that folks are comfortable with what we've written in this report. All right, proceed. Unless we're done.
You're done.
Okay. Anything, Senator Ross?
More questions, yeah?
No, that's all right.
All right, so on page 351, we've changed it from will to should on, get back to that page, excuse me. With regards to public market search, why did we change what the report should include to should?
I think this was, Vince, I think this was a recommendation from staff. If it
is.
does, I would say it does include all this.
I think it's just flexibility. It's not a directive, it's it's a directive still, and should, but it's just increased flexibility.
But all that's important information that we should know, right?
Yeah.
What we include.
We've seen that type of flexibility worked into most policies now, and the intention is not to change the process or the requirement, but really to, I think, avoid being out of compliance or in breach of the policy when that's not the intention. So I think the spirit is the same, it's just not as binary as yes or no. So
We had a lot of flexibility 10, 12 years ago. Got us in a lot of problems. And we kind of worked through that. We've rebuilt some credibility. I'm very concerned that we do these types of things and We talked about flexibility earlier. We talked about transparency a lot. But I think we gotta be pretty careful that we begin to allow ourselves to open up to old habits, even though we got different folks. So I'm concerned about that type of language. And then also in general, it seems to me that this document shifts the responsibility for investments from this council to the SIO. Is that right?
I think the intention and when you, it's a little convoluted in some points, I suppose, even though I think we try to work through that. I think the big differentiator is that all the decisions are made on the council level. None of that changes. I think what is more reflected in the policy now, that's already been happening, is that the implementation of your decisions, of the decisions of this council, are being delegated to SIO staff.
To implement.
For the implementation process, not to make the decision, but to give them, through language in the policy, the ability to implement those. So the transition manager bench, I think, is a great example. You pick who actually sits on that bench, and then SIO staff actually selects them to then implement that decision in terms of which managers use to move assets. So again, you have full oversight, but then within those parameters that you set, allow SIO staff to execute on those decisions.
It's more to say, okay, you've made your decision.
Who's responsible for getting it implemented?
Staff needs to get it done.
So where's the section on responsibilities here? I'm trying to roll, so I'm trying to come back through all these pages.
It's for the council.
Well, for the council and the SIO.
The council is on 342.
Okay, and you got-
SIO is on 344.
Okay, so let's look at 342. In terms of the SIOs, or the SIC's responsibility. Okay, so actually it's on 343. And basically in the third paragraph, right, it says the SIC is responsible, basically for studying the policies and benchmarks. Right? And not in terms of all the investments. So we set the policies, we set the benchmarks, we set the guidelines, and then we go over to the council investment committee. And then you got the next one over where the SIOs at.
Oh, it's on that C, that section on 344.
Okay, so it says, first paragraph says the CIO has responsibility to direct and implement all decisions required to achieve the SIC's approved strategic investment direction. So to me, this is a move to take the responsibility and the role of investing from this body and move it directly to staff on those decisions, and then only leave with this body the actual general strategy and policies. And I would like to see that debate, if we're gonna have that. We've got some members that aren't here that should be involved in that debate as well. Listen, that's a bigger discussion where we've had some, quite a bit of disagreement.
I don't read it in the same way, but one option here, that is a bigger debate. I don't see it in the same way that you do, but don't disagree that you want to make sure we have clarity where we need clarity. Director Ruiz, can we defer this to January, and can we have a couple of folks go through it, provide recommendations, and then give us another review?
Yes.
Another chance at this? All right.
I would prefer that.
Okay. And you're winning a whole bunch today. Don't get used to this. Okay. You were fun just a minute ago.
You got a beautiful outfit.
Wow. You're out. Grounded, off the committee. All right. So do I have anyone who is concerned about that recommendation to defer this item until the January meeting? And that I would encourage members to read through it again, myself included, to take into consideration the comments made by Senator Rossum and anybody else about whether we're getting this right. So look at the flexibility issue and the policy statement, make sure that what we did today, you feel like it's reflective. So I'm looking at the land commissioner, fair point, and then Senator Rossum, if you can get to the director, issues that you're concerned about, and I'll take on staff. Does that work?
Yes.
Okay, all right. Okay, item deferred. Okay, we are now on number 4, finance matters. So it's a discussion and informational reports. We do the audit committee report and the CFO report.
I'll be quite brief. Being how Peter's on the phone, I'll touch on a few things that happened at the audit committee. I'm on page 415, which is the exit conference material that Moss Adams, our external auditor, provided. This is mandatory that this information be disclosed to the audit committee. And Jim Goodwin, whose last meeting was on the 21st. He's usually the one that presents this, and I've been delegated that responsibility. Just very quickly, on page 416, I'll be super brief. Moss Adams will issue a report as of June 30th, 2019. They'll be issuing that report. In fact, the draft has already been delivered to the Office of the State Auditor. It's a unmodified report, meaning no qualifications.
I can't hear when you guys are whispering, I'm so sorry. Okay.
The issuance date, they said here, would be no later than November 27th.
Could you repeat what you said, please?
Unmodified. Okay. Yeah, the report is going to be unmodified. It will be issued as of November 27th, which is the due date. Actually, I think they've already submitted it, as I said, to the Office of the State Auditor. And then just a couple of other things to emphasize, things that we're very proud of. No material weaknesses or significant deficiencies noted. No compliance findings were noted. If you turn over to page 421, they do emphasize that as auditors, they form and express an opinion about whether the financial statements are presented fairly. It does not relieve management of their responsibilities as it relates to the audit. Significant accounting policies are summarized in note 2 of the financial statements. The financial statement disclosures were consistent, clear, and understandable. Representations were requested and received from management by Moss Adams. No adjustments, and I think you should have to see the parentheses there, other than adjustments provided by management during the audit. One of the things that we touched on earlier was the quarter lag. We do catch up that quarter lag reporting as of year end, but we provide those adjustments to the auditors as part of the audit process. And they further note that there was no uncorrected misstatements that were noted. And then going over to page 422, they also indicated there were no significant new accounting pronouncements. I think this coming up here, we have one on leases and one other dealing with fiduciary funds, but that's for this fiscal year that we're in. There's no disagreements with management. Consultation with other independent auditors, none that they were aware of. And you might be wondering why they have that verbiage in there. Entities have been known to opinion shop. They're very interested that does not happen. We did not do that, and so they noted it. Difficulties encountered during the audit, there were none. Illegal acts noted, there were none. Ability to continue as a going concern, there's no disclosure required necessary there. Consideration of fraud in the financial statement audit, they do go in and look at journal entries and interview personnel as it relates to that. They noted nothing there. And then they further note that they're independent with respect to New Mexico State Investment Council and the state of New Mexico. And then finally, On page 423, they indicated that the audit was performed within the scope and timeline discussed during the inference meeting and the audit planning meeting. All requested schedules that they asked for and information were provided on a timely basis. We discussed this, Jim did in great detail after this meeting, but one of the things that they do highlight there that we are very proud of as an entity is the tone at the top and the attitude for management and staff was one of helpfulness, candor, and openness in response to audit requests and discussion points. On that page 423, we've all your manager on the job. If any of you have questions on anything as it relates to the upcoming audit report, it's in draft form right now. We'll be supplying information to the CAFR unit at DFA probably today. Hopefully I'll do that before I leave tonight because I'm on vacation tomorrow. But we're hoping to meet all deadlines. And I also wanted to thank Lee and Tracy for being available for the exit conference. I know it requires time and effort. And I also want to put a plug in for Jim. He's been on the audit committee and is rotating off after 8 years. To have someone like Jim, who was a retired PwC partner, as well as Peter Frank on the audit committee, it's really a joy to be able to deal with him. And then lastly, I just wanted to say a special thanks to my staff. I have an excellent investment accounting manager, Nicole Gallegos. She's a financial coordinator at Two Sanchez that I very much enjoy working with. And then my administrative accountant, Rita Sheik, really came through during this audit. And that's all I have.
Thank you, Member Frank. Do you have anything to add?
I think covered it appropriately. That's of course what the auditors privately the presentation, and they were very complimentary of the staff and the tone from the top from Steve and Vince, and we are extremely satisfied with the performance of our financial group at the SIC, and quite pleased with the outcome of the audit this year. So thank you very much.
Right, thank you. Any
Also,
questions or comments?
Of course, I'm very regretful that Jim Goodwin has done an incredible job for us. His expertise is retiring from the audit committee, and we applaud his service and thank him extensively.
Right, ditto. Thank you very much. Okay. CFO. Done. I'm making sure you got this separated for two things. Audit and your report. I'm happy to
Yeah, I really don't have anything other than to say that once the audit report is finalized, it is protocol that we'll route that report to everybody so that you all have a copy of it once it's finalized. There is a coordination and effort between the Office of the State Auditor and DFA. DFA actually has to give the nod to the state auditor that they got everything that they needed as it relates to the audit report, including journal entries, other requests that they have. So we're hoping to have that report finalized probably in early January, if not before then.
Thank you. All right, we're on number 5, closing matters. Any old or new business?
Madam Chair, in the interest of time, I just have a annual report from the State Land Office, which is required by statute with a formal transmittal letter for you, Madam Governor. And then I've got copies for members and SIC staff.
All right, thank you. You're doing a bang-up job, and we are really excited to have this report. Thank you very much. All right. The next SIC meeting is Tuesday, January 28th, right here at 9 a.m. So thank you very much. And we are now on item 6. It's the public comment period. Do we have anyone here today to make public comment? You want to come over here and state your name? Thank you. Thank you for waiting.
Thank you, Madam Governor, council members, good afternoon. My name is Daniel Pritchard. I'm a member of a volunteer organization called Renewable Taos. and the members have been promoting renewable energy and economic development in northern New Mexico for about 8 years now. I'm a retired electrical engineer. My comments today are primarily on the ETA, the Energy Transition Act, and in-state investments. The Energy Transition Act mandates 40% renewable energy by 2025. That's only 5 years away. Where are we today, and how are we going to get to those 40 and 50% milestones coming up in the near future? About 18.5% of New Mexico's energy needs are met by renewable wind and solar today. That means we need to more than double our renewable energy generation in 5 years. We get about 5% of our electricity from solar. We are 16th in the nation in solar energy, behind New Jersey, Massachusetts, and even Minnesota, of all places. We are not the solar capital of the world. To double our solar from 5% to 10% will cost about $1 billion. That does not include any energy storage. $1 billion to go from 5% to 10% solar. In the last legislative session, House Bill 289 called for 1% of the severance tax permanent fund to be directed toward renewable energy and related technologies. That's only $50 million approximately, and that won't go very far to getting us to the ETA requirements. I'm sure the SIC and staff knows that there are many opportunities for investment. Here's a recent example. The Canada Pension Fund, the Canada Pension Plan Investment Board is acquiring Pattern Energy Company. Pattern Energy owns or is building about 3,000 megawatts of wind turbines in New Mexico. So Canadian pensioners will be living off the profits of wind energy generated in New Mexico. In Texas, they announced another 100 or 500 megawatt solar project about once a month, it seems like. They're going crazy in Texas and Arizona. We are way behind our neighbor states. We will likely never catch up. I'm glad to hear about more investment opportunities and emphasis in New Mexico. Please help us citizens also understand how the state's resources and assets can help meet the Energy Transition Act and renewable energy mandates. Thank you very much.
Thank you very much for being here. Thank you. Appreciate it. Yes, sir.
I was going to speak on something similar. I'm really glad to hear his comments.
Can you give us your name again?
I am Greg Sonnenfeld. I do a lot of political advocacy. I'm also a physics engineer. I work at NASA in Milano, then contracting with the DOE. And from what I've heard from talking to officials, we have about 4 gigawatts of renewable energy projects in the queue right now. It's about very roughly $4 billion. And I think that we need to be investing in these. There's a lot of talk about investing in venture capital in New Mexico, which is good. There's been talk today, I'm surprised to hear that a lot of the fixed income is actually negative right now. And so I think there's a really great opportunity here for the State Investment Council to be investing in utility scale financing of debt. These, according to a recent NREL report, they get returns of about 4.5 to 6.5% on this debt. It's backed by equipment, so it is a fairly safe investment. I'm sorry, I'm a little nervous here. I think that state financing, for financing these projects, we could actually incentivize putting more investment on state lands. We get larger leases, we get a larger influx of income from these projects. I think this would also be a good way to showing that New Mexico is a very stable place to invest in renewables because we are investing in it and we can make sure that it's stable and it makes New Mexico a lot of money. So there are some deadlines coming up, soft deadlines for renewable investment. In 2020, there's a 26% investment tax credit. It makes it very profitable to invest. 2021, it drops to 22%. It's still a reasonable tax credit. In 2022, I believe it drops all the way down to 10%. So I think most of this investment is going to happen between 2021 and, 2020, 2021. And it's likely we're going to have, I would say more likely than not, the tariffs on solar are going to come down in 2021. And we are best in solar. Deming has the second best solar density in the country, only surpassed by the Mojave Desert, and we have a better environmental conditions for it. So that is a place where this might happen. We have a mine there that uses 50 megawatts of energy. So I think that investing in debt for renewable projects might be a very good thing for our various funds to maybe replace negative return fixed income. And I'm hoping that maybe we could do some investments out of the state land grant fund if we can get the legislation and have that investment encourage more investments onto state land, to get larger state land leases. Thank you.
Thank you very much. Just a quick response. Gets into the record, very powerful. We want public comment. You're hearing that we're looking at productive prudent strategies to invest in a range of things in New Mexico. So we appreciate getting feedback that those aspects, without being specific about what, when, where, that happens as we go through these meetings, but that's beginning to occur. So it's nice to have the public here to confirm that we're beginning to look at the right stuff and gives this group, this professional group here, a sense that where they ought to be looking. So thank you. All right. Do I have a motion to adjourn?
Okay.
All right. I know you don't want to leave. These meetings typically are about 3 hours, and I made them longer, so thank you for staying. I'm really grateful that you did that. Do I have a second? Got a second by Member Eisen? Question, all those in favor say aye. Aye. Any opposed? Motion carries. See you all in January. Thank you. Happy Thanksgiving, everyone.